The year, but they're searching still for a new CEO, and so that clearly adds to a little uncertainty on the stock. Guy?
Okay, here we are, 10 seconds to go until the opening trade here in Europe this morning. We are anticipating that we are going to see a bounce for European equities. How convincing will that bounce be? Have positions been cleared out? We're about to find out. We'll see how the session develops, but here we go. Time for the opening trade here in Europe this Tuesday morning, and what we are already seeing is some green on the screen as anticipated, but how much green on the screen? I know it's hard to tell exactly at this point simply by looking at one index, which is the FTSE 100, which is open 0.2% higher. Stock 600 up by around 0.5%. You've got the IBEX up by around 0.1%. Let's see how much momentum we get into this trade over the next few minutes, and how much higher we can push. But I think it's always going to be on days like today that you want to look at the context. You want to look at the last 2 or 3 days just to give you an idea of really where we are. Don't look at the single session. Don't look at the dip buying in isolation. Look at it in context in terms of what is happening here. Kriti, let's talk about the details of what is going on under the hood.
Well, Guy, right off the bat, some of the moves you're seeing seem to be in some of the mega cap stocks, and actually your sensational six, if you keep looking at them. Novo Nordisk, for example, and ASML are your 2 biggest index contributors to the upside. So that's going to be pretty significant, including some of your other tech players as well. SAP is one, of course, that we know that got hit pretty hard yesterday as well. As some of the oil names are starting to come through as well. Shell, Total, for example, Anna, you are starting to see some of those moves. BP even. It's kind of the underperformers of the last couple of days are their outperformers today.
Yeah, absolutely. Banks in that mix as well. So a bit of a rebound in technology, a bit of a rebound in the banking sector. And if we were thinking yesterday about the speed at which central banks might cut rates, maybe that's negative for banks. We saw that as one of the global themes. Today be something a little different. We do have some sectors still in negative territory this morning, just a few of them. Utilities, personal consumer goods, consumer products and services is one of the weaker spots. And we do have that weakness on the CAC 40, which is interesting. Some of the luxury names do seem to be suffering today. So the likes of Richemont, LVMH, Christian Dior, L'Oreal, we see weakness in some of those luxury stocks.
Take a look at the stock 600 over the last 3 sessions. We're still down by 5.5%. So yeah, we are still down heavily at the moment in terms of the longer term picture. I'm not even sure 3 days classifies as a longer term picture. So we are getting a little bit bounce this morning. But if you take a look at it on the 3-day chart, it looks like a very, very small bounce.
Our colleagues in Bloomberg News putting this in context, talking about the last 3 weeks and calling this a $6.4 trillion rout over the last 3 weeks. And to some extent, we need to keep that in our minds as well.
Let's get another take on what is happening here. Maria Manucci joins us, fund manager at M&G Investments, sitting around the table. Nice to see you this morning.
Good morning.
What do you make of what we've seen over the last few days? Put today in context. Tell us what your clients are asking you about what they do now.
Well, I think, as we were saying, it's about the last couple of days, but it's really something that has started earlier than that. And a lot of the factors that have been driving some of these risk-off momentum in markets have been in place for a while now. If you look at things like the slowdown in momentum in terms of the growth picture, but also inflation normalizing more and more, the starting of the cut cycle on rates across the globe, really. So there's been many of those elements that have been in play for a while. I think, to me, the biggest shift has been that while for the first part of the year, the market has been able to be upbeat beat thanks to the AI narrative that has been coming in pretty strongly. The last few weeks have seen a bit of a loss of momentum on this. We started to see some challenges around, this AI spend. What would it actually mean in terms of short-term profitability and revenues for those companies, and more at large for the economy? And with that starting to crack, I think some of the other issues came to the fore a lot more strongly, and those were then exacerbated by the first cut within the Bank of England and this differential of behavior across central banks.
Does it feel like that we are heading into a recessionary environment? That's what the kind of the other big challenge has been over the last few days, is the market's trying to get its arms around understanding whether we're no longer in a soft landing environment, whether we're moving into a hard landing environment.
Well, I think we certainly have the market been moving more with the odds on recession than it was before.
Yep.
But in terms of the data points, we still don't have enough evidence to be backing that scenario strongly. I think the labour market has seen the weakening that we've seen last Friday, but it's one data point. We know it gets revised. We know there has been, still
some weather factors.
Exactly, some weather factors around the hurricane, and also that we are in a stage of normalization of the labour market rather than sharp weakening. But having said that, we know the labour market can move very quickly, so it's definitely something to watch for the coming weeks and months. But I think as of today, we still don't have a clear picture of are we going to have a recession or not in the coming months. So the options are on the table, and I think this is why you're seeing the type of volatility you're seeing, but also today kind of like a more of a rebound or a pace in volatility in markets. It's going to be interesting this week because there isn't a lot of data out there to be able to point investors towards one direction or the other. There will be more next week, but it remains a question if this week we'll continue to see a bit more of price having price, or the higher volatility bringing volatility with it, or if actually we're going to have a pause as we're starting potentially to see this morning.
Well, speaking of normalization in the labor market, let's talk about normalization in valuations as well. So many people are talking about these concerns of recession or whatever. How much of this is actually a big sigh of relief for the folks who want exposure to the stock market and didn't dive in because the valuations were too high?
Well, I think you definitely had a strong correction, but it's quite selective as well. So there are still areas of the market that were quite expensive 3 weeks ago, and they still are, to my opinion, pretty expensive. At the same time, you have pockets of the market that have started to rebound in, the first phase, if you want, of these last 3 weeks. So we had started to see a bit of rotation in the market, which I still believe are attractive, and today are potentially more attractive because of the widespread sell-off that we've seen in the past couple of days. So I think we have to be cautious, and overall, from an equity allocation standpoint, I would say neutrality is probably a good place to be. But within this neutrality, you have more opportunity for selectivity, especially after the recent sell-off that we've seen across markets, really in different regions, but also across different sectors as well. And in particular, those sectors that have been, lagging year to date, that have still seen some sell-off in the last couple of days, and they can start to be interesting, especially if we enter a phase of rate cuts in market in the coming weeks and months.
Yes, tell me about your thoughts on that, Maria. I mean, we were talking to Max Kettner earlier on. He was saying he thinks the front end of the curve is now pricing in too many cuts. And yes, there are a number of global banks now looking at 2 cuts in September and 2 cuts in November. When I say 2, I mean 50 basis points, of course, from the Fed. Is that too much, to get 4 25 basis point cuts in such a short space of time?
I think the Treasury market has moved very, very quickly. We've seen moves that are pretty rare to see. And in particular, as we look at the short end of the curve, I think there is some cautions to be had there. Overall, across US dollar duration, still pretty positive. I think, if you look at the long end of the curve, 4% rough rate is actually quite interesting over the medium term. We're starting to see some decorrelation as well of the Treasury market versus equities in this risk-off phase, and that's very positive for multi-asset investors. So still positive on duration, but less so on the short end, more on the longer end of the curve, I would say. We had, in the past few weeks, increased duration because we're starting to see this rotation in the equity market as a potential signal for more volatility to come, and that has paid off in the last week or so. But I think still constructive in the duration on the long end of the curve as an interesting diversifier for multi-asset. in markets that continue to be challenging from a macro perspective.
Do we think that we're going to be in a period of higher volatility from here? You don't have to look far to see political potential flashpoints. Does that keep us in an elevated? I mean, this wasn't driven by politics.
No.
But then you can overlay that and geopolitics.
Yeah.
Do we think that things are not going to be as low vol as they were over the last years?
Well, definitely on the equity side, you're potentially, looking at some more boots of volatilities coming in. Obviously, I'd say volatility has remained relatively well behaved within equities, and we've already started to see this breaking out a little bit. So I think, especially as you go through a phase of, potential rate path coming down, it's not a smooth path either. So it's not smooth on the way up, but it's also not simple on the way down either. So I think there is possibility to see some volatility and for investors to pick opportunities along the way. What's interesting is that we've continued to see high volatility within the fixed income market, the treasury market, and sovereigns in particular. And that potentially might, subdue a little bit if we start to see this decorrelation starting to take place again between equities and bonds regaining this role of safe haven, which they kind of, have had difficulty to maintain in the last few years.
Yeah, kind of going back to a little bit of the normal roles that everyone kind of plays in a portfolio. Maria Minucci will lead the conversation there, fund manager over at M&G Investments. We thank you so much. Guy, when you look at this market action, it feels like it's a story of the mid cap stocks.
Yeah, big caps are coming back. As you pointed out earlier, this is where we saw most of these stocks, most of the action yesterday. They were pretty badly beaten up. This is where you probably buy in first. It's the easiest place that you would necessarily want to buy in first. You can see it really across the board in terms of the stock story here in Europe. The big cap stocks, Novo, LVMH, ASML, all higher. The more safety trade story, Nestle was certainly an area you could see some safety yesterday. That's not budging very much. Interesting that luxury is not having that great a morning, which is interesting as well. So Ferrari a little soft as well. LVMH struggling in and out of positive and negative territory, Anna.
Yeah, the CAC 40 is up actually now, but only by 0.2%, so underperformed still a little bit, and luxury is part of that, but also Sanofi weighing on that market. Let's get a check on some of the individual stocks then on the move. Joe Easton has a briefing. Joe.
So the best performing stock we've got today is Banca Monte dei Paschi out of Italy, gaining the most in 18 months following the company's earnings report. Now, their net income in terms of their interest income, their fee income and their expected dividend, all beating expectations. That was up as much as 10% at the open. Then in terms of over in Germany, we've got Zalando, better than expected sales for the clothing retailer, only up 1.5% at the moment. And Aberdeen actually bucking concerns around those outflows at the fund manager, potentially the cost-cutting helping over there. Travis Perkins, the UK DIY firm, meanwhile, actually reporting weakness in its French business over in the Toolstation unit today. So that is weighing on that stock today. But those are the big moves in terms of the corporate earners. Then we mentioned IHG. That was one of the best performers at the open of trade. Coming down a little bit now, up 2.5%. Revenue per average rem pretty strong at the moment. And their buybacks also continuing as well. Bit of a rebound, some of those other hotel stocks, given the declines we've seen over the past few days. Melia in particular up 3%, but also Whitbread and Accor as well. Wanted to check in on some of the energy stocks, given that move of only around 0.7% in the Brent price. WTI a bit higher, BP coming up, Total not seeing too much of a move, and checking in on the defence stocks as well, given continued concern around relations between Iran and Israel today. A little bit of a move higher in some of those companies, Rheinmetall and BAE Systems. Another sector to keep an eye on, of course, is tech. Now, Deutsche Bank, in a note today, upgrading the sector to neutral from underperform. They note that 30% of the downturn in European stocks that we've seen recently has come from tech. And these were some of the worst performers yesterday. Bit of a rebound coming through in Just Eat, Capgemini and SAP, but actually ST Micro over in chips continuing to decline very slightly. Finally, one single stock morning call to bring you. It's over in the health sector, and that was one of the best performers at the open as well. Argenx, this is the antibody company listed over in Belgium. Barclays likes that one on their earnings rebound, and the stock's up 3% in early trading today.
All right, Joe Easton from our equities team, we thank you so much for bringing us some of the stocks to watch. And coming up, we're going to dive into more of the company stories. Shares of IHG Hotels and Resorts higher this morning after the group posted pre-tax profit ahead of estimates. We speak to CEO Elie Maalouf next on the program. Stick with us. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Welcome back. You're watching the opening trade. We are 16 minutes into the equity market session. As you can see, it is a broadly positive one that we are watching. European stocks are bouncing back, but I would take a look at a slightly longer term chart and take a look at the last 3-4 days, and you'll still see that we have yet to really kind of close back the gap. So yes, we're getting a bounce this morning. Does it fill the gap left by the sell-off over the last few days? Probably not. One stock that is shining this morning is IHG, the global hotel chain, out with numbers a little bit earlier on. The buyback story continues. The market likes that. The RevPAR story looks pretty good, so the numbers are coming through quite strongly. The company's CEO, just over a year into the job now, Elie Maalouf, CEO of IHG, joining us now down the line. Nice to see you. Look, the numbers look strong at the moment. You're opening a lot of hotels. You're bringing a lot of capacity into the market. Demand looks like it is still reasonably elevated. I'm starting to see some evidence in the airline sector that they are starting to see maybe some cracks appearing. Is there any evidence that we are starting to see demand softening, or are these numbers consistent with decent momentum in the group?
Well, thank you. Good to be with you today. I mean, first of all, like you said, it was a good set of results for the half, accelerating in the second quarter in our RevPAR due to our global distribution, a good recovery in the United States, operating profit up 12%, adjusted EPS up 12%. So across the board, good flow through to our results. And we're still growing. We added 129 hotels. We actually signed a record 384 hotels in the half. That's more than 2 a day. We continue our buyback, as you said. We're going to deliver return over $1 billion to shareholders this year. So we're pleased with the trajectory, with the performance of the business. You know, airlines are not a direct read across to our industry and to our business. Most of our travel is still motorway travel, and we've seen in the U.S. Record Memorial Day, record 4th of July travel. Yep. AAA is projecting record summer travel. So is TSA projecting record, passes through, security passes through the airport. So it seems like a very good start to the summer, and even beyond the second quarter, looking into July into August, we're seeing, broad continuation of that trend.
A lot of people in the markets, Ellie, over the last few days have got very concerned about the fact that we are heading towards a recession, particularly in the United States. What I've just heard from you doesn't sound like a recessionary environment to me.
Look, the data is early, and we don't draw conclusions from a few days of volatility. We watch it carefully, as you would too, but we don't draw any conclusions yet. We wait for a few more months to see if any patterns emerge. We're not seeing anything in our business for the moment. I'll also reflect on some of the data. I mean, yes, we saw unemployment tick up to 4.3%, but actually, if you go underneath it and you look at the number of people employed, that actually grew in July over June. And the unemployment rate was more driven by more people coming into the labor force. So more people working is actually still good for our business. And so I think that if unemployment settles down in the low 4s, if long-term interest rates, come down as they have, if inflation stays lower as it's come down, that's actually a pretty supportive environment for economic growth into the rest of this year, into next year, and very supportive for the development of our business. So we're not seeing anything in our information and our performance right now. We keep watching the data, but I think there are different views that the economy can still continue its growth. Over the last 2 or 3 years of recovery since the pandemic, there have been several calls for U.S. recession. In fact, they've just turned out to be corrections with a resumption of growth.
Well, Ellie, speaking of that demand story, and I appreciate that it is looking good and things are all kind of rosy from your perspective. I'm curious when that translates to things like pricing for your actual business itself. How much headroom do you have right now to actually increase that pricing? And this is in comparison to some of the story we've heard from other consumer brands like Chipotle, for example, or McDonald's. And I understand it's a different sector, of course, but the conversation you're hearing there is that there isn't actually much headroom to increase pricing. How much headroom do you have?
There are different sectors, as you said. If you look at pricing for our industry in the United States and in Europe, it's actually only kept up with inflation since the end of the pandemic. There's been inflation, which has subsided, but our pricing has not exceeded inflation, so we don't think we're ahead of it, as maybe some other sectors are. And our business is still growing. It's not just really a pricing growth business. It's a demand growth business and a footprint growth business. We grew our system 3.2% year over year. We opened 126 hotels. We signed a record 384 hotels. When you look at the long term of this business, as long as GDP continues to grow, as long as the middle class continues to grow, travel is something people are really preferring to do and continue to want to do. And so we're very optimistic about continued demand growth going forward in the long term.
So, Ellie, that's the optimism and the resilience story in the States. Walk us through what you're seeing in China in particular. I'm looking at numbers here that your room revenue actually fell for that part of the world. Yeah. When we're talking about that middle-class consumer, what are you seeing in Asia?
Yeah, it's a good question. Our comparable RevPAR did decline in the second quarter after being up in the first quarter. There are a few things at play in China. First, in the second quarter, we're coming up against very strong comps in 2023 second quarter when travel restrictions were lifted and we saw a surge of demand, mostly domestic. Second, that demand, which was domestic last year, quite a bit of it shifted to international outbound from China, mostly into nearby Asian markets. So actually, our Asia-Pacific region was up 15% with nearly every country, Thailand, Vietnam, Japan, South Korea, Singapore, up double digits. So we benefited from that, although it was not so much in China anymore. The third is that international inbound to China, which has been recovering, still is a long way from when it was in 2019, and we still have some demand recovery there. So we're still optimistic, very optimistic about the long term in China. That middle class that you mentioned, that's expected to grow by 80 million households over the next 10 years. 80 million households. And then you have a penetration of hotel rooms per capita that's still 1/7 of what that is in the United States. So an industry is under-penetrated. our owners, our hotel owners in China seem to agree. Our openings increased 50% in the half. Our signings increased, nearly 40%. We're going to reach nearly 800 open hotels this year in China, with another 500 under development. Look, we know it makes highs and lows, but it makes higher highs and higher lows, and we're very optimistic about the long term in China.
Okay, so that's the optimistic story around China. Ellie, could I bring us back to the UK? And I want to ask this question not because it perhaps shows up in the bottom line, but because it's got just had a lot of attention on it over the last few days. Far-right violence in the UK, pockets of the UK, I should point out, and at least one of your hotels being caught up in that. I'm sure your focus is on your staff and the residents of these hotels, but what can you tell us about how this impacts on the business? I'm thinking whether the costs are insured, for example.
Well, look, first of all, it's sad. It's troubling to see these scenes. We're confident that the authorities, the Home Office, the police will restore calm and order, and we're working very closely with them to assist in that. In the UK, we have 350 hotels out of our 6,400 plus around the world. So it's about 5% of our system. There is a very small number of these hotels that are with the Home Office right now. And so it's really a very small part of our business. We don't think it's going to affect our business, but really our first priority is the safety and security of our hotel staff and of the residents. And we're confident that the Home Office and the police will do their best to protect it.
And moving to another geography, but close by, Paris and the Olympics has got a lot of our attention then, Ellie. We've heard anecdotally from some in the hospitality sector that maybe this hasn't delivered against high expectations. I know that this isn't the biggest part of your business by any stretch, but what can you tell us in terms of high-frequency data coming out of Paris? How is the Olympics doing for hospitality?
Well, first of all, it's been a thrill to watch some of the events and the athletes. I wish I'd been able to go in person myself. But look, we have less than 70 hotels in France, a little more than a dozen in Paris, but we're very pleased with the performance. Very pleased with their performance during the Olympics and throughout the summer. So I don't know what it means for others, but our hotels in France and in Paris have done quite well.
You've done quite well. No sense that people didn't show up for this Olympics?
Well, I'm sure that when you have major sporting events, you have some people don't show up, mostly business, but then a lot of people that show up to see the events themselves and enjoy them. In our business at IHG's hotels in Paris and in France, it's been a good Olympics and a good summer so far.
Okay, Ellie, thank you very much. IHG Hotels and Resorts CEO Ellie Malouf there, taking a trip around the world. A positive story coming through in China, and to your point, Guy, not a story in the US that sounds like recession.
Sounded really quite positive. He doesn't necessarily draw a line between the weakness we're seeing in the airline sector, and we've seen warnings coming through from airlines like United over the last few days. He doesn't see necessarily a very strong connection. A lot of people drive to his hotels, which tells you, again, something about maybe what we're seeing there as well. But it's interesting, it doesn't feel like he sees a recessionary environment.
But it's also a little bit of a trade-off, right? Because when you can't fly to, say, see the Olympics, for example, you drive instead. You take a road trip. It's the classic trade-off, especially right now when you are seeing actually gasoline prices fairly high. There's an incentive built into that. I'm curious how much of that is an income gap kind of story.
Yeah, is it the ultimate trade down then? Well, that's a very positive story coming through from Ellie, so perhaps we'll ask those questions next time around. Coming up, we will focus in on the UK. UK Chancellor Rachel Reeves declines to rule out increasing capital gains tax. More from our exclusive interview. She has been visiting New York, also about to visit Canada. We'll get the view from the road. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning. This is the opening trade, Tuesday the 6th. We're 30 minutes into the equity market session. This is what it looks like this morning. You are getting something of a bounce, but it's not exactly a convincing bounce, is it? We're up by, let's call it, circa 0.8% for most markets. The CAC is definitely underperforming. Luxury looks like the laggard this morning, certainly when it comes to the French market. And if you take a look at the picture since the beginning of August, 1st, the 2nd, the 5th, the 6th, which is today, we are still down by 5.2% on the Stock 600. So equity markets are bouncing a little bit, but it's not convincing yet. Have we seen the clear out of positions as well, I think is another question we still need to ask. Volatility, Anna, has come down, but it still remains relatively elevated. Therefore, are the systematic funds going to continue to sell? Are we going to continue to see some of this unwind that we've seen over the last few days continuing into the rest of this week?
Yes, and it's interesting, we talked to a number of people about this turnaround Tuesday and whether they're buying into it yet. And there's a little too soon, seems to be the soundings we've got this morning. Sometimes for similar reasons, actually. They do think there is a time to buy in, but maybe just not yet.
Well, I think that the positive sign here is that the volatility is coming down, even though it was very high yesterday, and even though the trajectory may still have a ways to go, it is coming down. So maybe by the end of the week, things will have a little bit more clarity on that front.
But how long does it take to clean out these positions, I think, is a really interesting question. Often the models don't update particularly quickly. Volatility has been really low for a really long time. So the pressure within the system on the upside has built up really quite significantly. And it probably takes a few days to clear that out. Now, we've had a few days of selling. Is this something that is going to necessarily need to persist? How much of those weak hands have been cleared out, I think, is an open question at this point. And I think to Anna's point, that is why I think you're still seeing the caution. I'm seeing note after note this morning saying we're not sure that all of the positioning is done yet. We're not completely convinced that all of this has been worked out. So maybe there is still more to come. So a choppy week.
Yeah, choppy. Interesting that Max Kettner was able, though, to give, even if it is too soon, able to give us areas that he thought have been overdone, oversold, risk assets that have overdone it. So, for example, Japanese stocks, that seems like a fairly obvious one. They bounced back substantially today. Industrial stocks, and then the front end of the curve, he thinks now we are pricing in too much in terms of cuts there.
Well, I got to say, and this might be the journalist in me, but I'm ready to find out who got the margin calls, who had to panic really quickly, and who the bigger players are, because in the previous crashes that we've seen that have been so quickly, I mean, a 45 basis point move in the 10-year in the span of a little over 48 hours is massive at a time when no one was really betting on a bullish bond market, and yet here we are.
The bond market has performed in some ways admirably over the last few days. I appreciate that the moves have been extreme.
Gold star from Guy Johnson.
Well, yeah, the bond market for a long time has not done what it was meant to do. You've seen risk assets and what should have been balanced in your portfolio, i.e. the bond market, moving in the same direction. Now, that blows up a whole load of strategies, which previously you would have thought that has worked. But over the last few days, you have seen this ballast in diversified portfolios, proving that they actually work. Does that mean you go back, therefore, to a more balanced portfolio? A lot of people have been super long equities. Are they going to maybe take a more balanced position?
I was looking at the GMM screen, which is sometimes useful as getting a sense of where markets are moving. And if you set it for month to date, it tells quite a nice story as to what's happened since the BOJ move, and if that was one of a number of triggers that has taken us into this place. But the sovereign bond column is just... it's the only green, really, on the screen. There's a few other currency moves. There you go. There's a couple. We've got a couple of green screens. But the sovereign bond column definitely stands out as one of those areas, to your point about the ballast.
But the disconnect between the bond market and the FX market is still fairly interesting. If you're seeing this massive move into the U.S. Treasuries, for example, from the 2-year to the 10-year, where's the bid for the dollar? And I don't see that yet, really, except for against dollar yen. You're still seeing, even in yesterday's kind of turmoil, you saw a bid into Eurodollar, a bid into cable. The dollar doesn't seem to be that haven, that safe asset that perhaps the Treasury market or even the Japanese yen or the Swiss franc has been.
Are you getting the flows, therefore? Why is that? What is going on, and why are you seeing that? Why are you seeing that happening? Because in theory and in previous instances, you have seen, even when the U.S. economy is crumbling, the dollar act as an area in which you could hide out. That's not happening this time around. That's a really interesting kind of tell on maybe the perception. Maybe that's also the kind of perception that maybe the U.S. market's got the most overheated in its totality.
But this is also bringing it right back to the positioning story, right? The market was long dollars, so so many people have been sitting on dollars that they don't need to kind of grab them to access the Treasury market or access the S&P 500 or whatever. So I feel like maybe that's the one spot in this market where we can actually say things are priced in.
One area we haven't talked a lot about is credit.
Yes. Mark flagged that, didn't
he was flagging a little bit earlier on.
Hadn't adjusted maybe as much as he would have expected, although the chart still looks pretty dramatic.
Yeah, precisely. The chart does look dramatic. So you are seeing a funding story that is beginning to get a little bit more squeezed. And I wonder kind of that maybe is the area the Fed, other central banks do pay attention to. The cost of credit does start to materially be affected by what we're seeing here. That's a read back into the economy, and maybe you don't see this huge amount of issuance. But a lot of people had already said that the huge issuance that we've seen was likely to be front loaded. That the back end of the year was likely to be more difficult.
Yeah, they were a lot of companies trying to get in ahead of very well telegraphed points in the political calendar where things might get a little unpredictable, and so that was the appeal, I suppose.
Well, in the context of the broader kind of risk appetite that we were talking about, especially with the carry trade, kind of this high risk, high reward story that's unwinding. In the absence of that, if you are seeking something a little bit safer, you can see it on your screen right now. This is the investment grade kind of corporate spreads here. It is, I can't see that far. It's about 112, 111 basis points. This is what Guy and Anna are rubbing off on me. But if you look at the high yield market, for example, 381 basis points on that very similar spread. So I'm curious if now, in the absence or in that worry of the kind of carry trade unwind, do you start to see a bid into some of that riskier credit?
Maybe the sell-off of the last few days has undermined some of the gains that people have been making in their portfolio, which is my way of segueing into our next segment.
Excellent. So beautifully done. Gold star for Guy Johnson.
Not really. 2 gold stars. Wow. One for the bond market, one for me. The UK Chancellor, Rachel Reeves, says that she will not rule out increasing capital gains tax after warning over £22 billion of a gap that exists in the UK budget now. In an exclusive interview, she told Bloomberg that she'll strike, quote, the right balance on tax at a budget that we are likely to see in October.
I think people should pay their fair share of tax, and one of the challenges we have in the UK is a gap between what should be collected by His Majesty's Revenue and Customs and what is actually collected. But we made a commitment in our manifesto that we'll be sticking to, which is that we don't want to increase taxes on working people, and we will be keeping income tax, national insurance and value-added tax at the rates they are for the duration of this Parliament. I would like taxes on working people to be lower, but I believe that you can't make promises without being able to say where the money's going to come from. But the tax burden in the UK has got too high. The tax burden in the UK is at a 70-year high. I want to bring that tax burden down because I want to make Britain the best place to start and grow a business, and I want working people to keep more of their own money in their pockets, and that's what people will have with this new Labour government. And it's why it's so important that we grow the economy, because the last few years in the UK, there's been lots of debate about what level of taxation and what level of spending, but it's missed the bigger picture. And the bigger picture is growing the economy.
Well, as you mentioned income taxes there, Chancellor, I wonder, given the revenue it potentially could generate, if you're tempted to bring capital gains taxes in line with the income tax, is that something you're considering?
We've got a budget on the 30th of October, and we'll set out our policy then. But it's always important when you're deciding tax policy to strike the right balance. Of course, you need to bring in the revenue to fund vital public services, but we've also got to grow the economy. And I won't do anything that makes it harder to achieve that economic growth and prosperity, because in the end, the only way we're going to lift living standards for working people and have the money that we need to invest in our public services, whether that is our health service or our schools or indeed our police and our armed forces, is by growing the economy. And so I am determined to ensure that when we set all of our policy, including tax policy, that we're not doing anything that will deter the investment and growth that we need to see in the UK economy. But we'll make decisions around tax and around spending at the budget and the spending review later this year.
Okay, Chancellor Rachel Reeves speaking exclusively to Bloomberg on her visit to New York, of course, talking to our team in Washington there, pitching the UK. Interesting then on the tax side of things, just to get very domestic, you know, she's talking there about private equity and carried interest and consulting on that. Interesting to see if they do try to dissect that into two halves, you know, the area of PE that's risking its own money and therefore rewarded for that, and the area of PE that is not doing that and therefore shouldn't be, in their view, rewarded for that.
If you put skin in the game, if you put skin in the game, you will get a better treatment in terms of the taxation because you are taking risk, and that it is designed. The way that capital gains tax has been designed in the past is designed to foster risk. The problem is, though, that in some ways it has maybe become too broad, and as a result of which has been taken advantage of. So it looks like it feels like CGT is going up in some shape or form. But it looks like the government's probably going to borrow more money as well. It looks like it's going to change the rules. Rachel Reeves is going to change the rules to allow herself that headroom to do so.
Well, she's not denying.
Okay.
When asked, not denying that she
pretty
might.
much
No
yes.
comment. With it. Well, I think the duality of that you highlight is really important, because if you ask the folks in the PE industry right now how worried they are about that carried interest story, they're not actually that concerned at the moment. And one of the arguments is that yes, it's kind of in the back of their minds, and it is lingering over all these issues. But they're saying, look, this is still an industry that is thriving. The UK government is still trying to attract so much of that investment, to your point here, and a lot of that is being done through private capital as well. So this is also a part of the market investor base that they can't actually alienate from that front. But we'll actually see how that goes. This is all part of the bring tech and innovation and deals flow back to the London narrative.
Yes, and she goes to New York trying to pitch, invest in Britain, open for business, and of course then the photos and the images that are travelling around the world of Britain right now don't exactly play to that. But on your point about private equity, she's said she had a frank exchange of views with people from the PE and the VCs community.
Is that a good thing? Is frank a compliment?
Not usually, but I mean, maybe she appreciated that. She said they were pleased with some of the other stuff they were doing around the UK economy.
Clearly there are big spending priorities, and the last few days have highlighted that. I appreciate that the riots we've seen in the UK have many different origins, but one of those is that maybe the Levelling Up programme has not delivered over the last few years what was anticipated in some of these areas, and more effort is therefore going to have to be made and more money is going to have to be spent. And that brings us back to the fact that she has some big priorities, she has some big needs for capital at the moment. How that comes in, I think it's going to be really interesting to see what this budget looks like.
Well, this is where you have to ask, is this kind of that Labour honeymoon phase that is starting to end a little bit? That if they are the political stability or island of political stability in broader Europe that you're seeing, can she capitalize on that, to your point? And it's something, by the way, that we're seeing in the markets as well. Not this morning necessarily, but we've seen that in the continued strength in cable. Cable at 127 right now, but still pretty elevated relative to, I think, some of the concerns around the deficit, et cetera, that you see in the UK. I want to bring another voice in here. Noor Ali, from our Bloomberg Markets Live team, joins us around the table. Good morning. Walk us through the take on the folks you're speaking to when it comes to investing in the UK. If we're talking about a catch-up trade in Europe, is the UK finally kind of getting its moment in the limelight?
Yeah, absolutely, Rudy, and that's the assessment, right? The British pound is doing very well. The Bank of England just cut interest rates. You know, if you're looking at the UK and the FTSE 100 as well, and the FTSE 250, which is the domestically exposed stocks, are quite undervalued relative to their peers. So if there's ever a time to invest in the UK market or to be optimistic about it, now is looking to be the time. You know, the summer is out. I've got way too many positives here to list, but I think ultimately ultimately the pound really rising is also starting to benefit those companies as well. You know, I've had earlier reporting on that as well from our colleagues in FX and rates. So it's really overall an optimistic story.
Okay, and that's the one she's taking to New York. We'll see what the budget delivers. In the broader markets then, Noor, clearly the risk-off story of yesterday being replaced by, I don't know, risk-on doesn't feel right, but a turnaround Tuesday perhaps, at least. What do you make of the seismic moves we actually saw in bond markets yesterday with the disinversion of the yield curve? That's right, isn't it? I've got the right words in the right order there. And what that tells us from here, because that happened really quite quickly, but then you get a sense it could unhappen quite quickly if we rethink how many Fed rate cuts we're going to get.
Yeah, absolutely. Look, that sudden shift in markets has been quite interesting, right? Suddenly, the markets have just turned. They dumped stocks at a time where they've been rallying despite a lot of the fundamentals or a lot of the macro signals that have said, well, maybe the valuations are quite lofty. Why are they still there? And the AI rally or that boom in AI has really carried that narrative through. And now we're starting to think, has that bubble popped? And in that light of everything, bonds, they're back because they came back as that sort of, okay, hi, we're here. We're the havens, we're the hedging havens that you're typically relying on. And so investors fell back to that familiar territory again. And you do see that there is room for those bonds for that bond rally to extend, particularly as the market is quite aggressively betting on the Fed cutting rates as much as two half-point cuts by the end of this year, right? But whether or not they do that may not be the narrative that's going to carry through as much as that sentiment that's driving the bond rally that we've all been waiting for.
We've been in a low volatility environment for quite a while. Take a look at the VIX. You can see the charts. And that allows risk to build up. You can build up bigger risk positions in a low volatility environment. Volatility has now come up quite sharply. How far down does it go? Do we go back down to where we've been really since the start of this year, sub 20, kind of in the mid-teens? Do we go back to that kind of environment, or does it remain more elevated than that period? And if so, what does that tell us about the ability of this market to take risk?
Well, Guy, the volatility beast is up. And once you wake that beast up, it's really hard to kind of move that away. And we've been talking now for quite some time, very perplexed as to why that VIX just was not rising, right?
Yep.
And now you even see the volatility of the volatility index, which is the VVI, the VIX, essentially also rising. So that's implying that we're going to see a lot more volatility into this summer. Also, a reminder, seasonality stocks don't typically do very well in August. It's pretty much a summer lull period. I argued over the weekend in our calendar post that actually I don't think that summer lull is going to come at all, right? And we're going to see a lot more volatility into Jackson Hole, right? August is going to be incredibly interesting for stocks and bonds. And I don't think it ends here.
Volatility doesn't come down to where it was before. Pay attention to that. It's worth paying attention to because it's going to have a big impact in terms of risk-taking. No, nice to see you. Thanks very much indeed. Emlai's Noor Ali joining us on what is happening in these markets this morning. Equity markets are a little bit bid this morning. They're not massively bid. What are we going to talk about next? NASDAQ futures are, though, a little higher. Big sell-off yesterday in the United States. Tech taking a beating. There's fundamental reasons around that as well. We need to talk about what is happening with NVIDIA. We need to talk about what is happening with Apple, etc. We'll do all of that next. That conversation is coming up. This is Bloomberg.
consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
We're 49 minutes since the opening trade here in Europe. As you can broadly see, we are higher, but not convincingly. Look at that. Some markets are even in the red this morning, which is interesting to see that happen. Luxury in particular is under a little bit of pressure. Tech a little less so. So tech had a bad day yesterday. Today we're seeing a little bit of a bounce back coming through, as you can see. Again, but these aren't big numbers. These aren't dramatic numbers today in terms of the bounce back. Now, remember, the Nasdaq was down pretty hard yesterday. It was down by around 3.5%. In 9 minutes' time, we'll get some pre-trade. We'll give you an idea of some of the big names and how they're trading into the US session, and we'll bring that to you in a few minutes' time. Let's get an idea of what happened yesterday. Tom McKenzie joins us around the table to give us his take. So yesterday we get a kind of a big sell-off, a broad sell-off. Tech goes down pretty hard. It's one of the most extreme positions. Understandably, if the market's going to sell off, therefore that gets pulled in. But there's also some fundamental reasons yesterday as to why we saw some of the sort of the darlings of the market recently coming under pressure. Nvidia feels like the ones that stands out. But there's some M&A stories. There's some engineering stories that compounded maybe what we saw yesterday.
Well, there was the Berkshire Hathaway cut to Apple as well, so that stake of around 50%. But you're absolutely right to zero in on Nvidia, because I think that's really important. The timing, of course, suboptimal in terms of Nvidia and the reporting around this that came from the information, and we have done our own reporting around it, which is that this crucial set of ramped up chips, so this new iteration of their GP chips, their GPUs, their AI accelerators called Blackwell, which is the next round to come up after Hopper, which is currently the one that they're shipping to most of their customers, that there are delays around this next product. And that comes down to engineering complexities around two of these AI accelerators. Now, they've come out, Nvidia have said, look, we're still on track to ship these in the second half. And the fundamentals are still there. They still are not producing enough GPUs, enough AI accelerators in the Hopper version to meet the demand that's out there. So analysts are saying, look, fundamentally, long-term, the growth story, the revenue story is still there for Nvidia, but, and this is a big but, doing the heavy lifting, it comes down to how quickly they fix these engineering challenges. And it's a reminder that as you innovate in this incredibly complex space, each iteration becomes that much more complex. Timing, NVIDIA want to be getting to a place where they're churning out new iterations on an annual basis. It's a reminder that there is a very, very ambitious goal. Interestingly, AMD saw some upside, even in everything that happened yesterday across these markets, even with that loss across the major index. AMD actually came through with gains because they are seen as benefiting from NVIDIA's challenges there.
So we wait for August 28th, don't we, until we get NVIDIA sort of on the record with the earnings and everything. Because the thing is that when you get this kind of story, these things have been, until recently, priced for perfection, haven't they? And so that's bound to raise questions. Let's go to other tech themes, though. And Chrissy's been rightly keeping the Alphabet Alphabet story on our radar and the regulatory questions there. I mean, a lot of the regulatory stories have been focused on Europe, but this one isn't. This one coming from the United States.
And the criticism often is that the US hasn't been able to sharpen its teeth around antitrust and around monopolistic behavior. This time, though, it's the first time in 2 decades that regulators and the authorities and enforcement in the US have come through with this win. So it's monumental in that respect, hugely significant. To be clear, Alphabet, the parent company Google, say they are going to appeal. But what this focuses in on, and I was reading the transcript or the final verdict that came through from the court, and they said very clearly, Alphabet, Google behaving like a monopoly, behaving with monopolistic characteristics. This is a monopoly. There was no ifs or buts about it, according to this ruling. And it comes down to the search engine and the fact that they've been paying, they make about payments of about $29 billion a year to companies like Apple, to companies like Samsung, the hardware makers of those phones, to ensure that Google is the default search engine. That, of course, helps them in terms of advertising revenue. They generate about $300 billion annually from that part of the business. What happens next is they're going to go to appeal, but ultimately they could break up this unit from Android, from Chrome, which would be hugely significant. There's still an if there, or they could get them to unwind some of these incentives, essentially Google paying these incentives to Apple, Samsung, and others to make sure that they're the default search engine. So that could come to an end. So there's still a lot of unknowns around this, but top line, as you know, Kriti, this is a significant finding from this and ruling from this court.
Well, this is my obsession of the morning, obviously, which I think ranted to you in a commercial break a couple hours ago. But this is not just a Google story. This is an Apple story as well, because you're starting to see the likes of Siri and chatbots kind of be programmed to use the same mechanism that Google has just been penalized for. And yet, on the other hand, you have the Berkshire kind of cut that you were just talking about. You have a couple of analyst upgrades, actually, out of Apple. Just basically, we don't believe in Warren Buffett. What is going on at Apple?
So Apple, well, there's the concern maybe around its exposure to China. And don't forget, they came through, actually, in terms of the earnings story, and that was part of the top-line picture that Guy was outlining for us in terms of the weakness across technology. And the most of the softness coming through from Alphabet, Amazon, and Microsoft in terms of the concerns that came through from their earnings. Apple, to some extent, was a bit of an outlier because they said, actually, the growth has come back, we'll come back with revenue, and we're going to see this upgrade, this iPhone upgrade, on the back of our AI pitch and the software and the changes and adjustments that we're going to be putting in place and embedding in our hardware from October of this year. So actually it was a slightly brighter picture, arguably, even as you saw that 6.5% drop in terms of revenues out of China. But we got a reminder, of course, yesterday that there still are concerns around Apple with Berkshire Hathaway cutting that stake. And a reminder as well that regulators are looking at Apple, they're looking at Google and Alphabet here in Europe, here in the US as well, around this alleged monopolistic behaviour, and those regulatory challenges are not going away in either jurisdiction. And we've seen that Meta, for example, the parent company of Facebook, they face challenges around their payment after adjustments and after rulings from Brussels, and that hit them in terms of the top line.
Okay, lots of threads then to the tech story, all of those individual corporate themes and the overall positioning around tech, clearly making its presence felt in markets of late. Tom, thank you very much. Tom McKenzie, of course, with the latest on the tech sector. In terms of, team, the things that are on the radar, I mean, tech earnings is one of them. We're going to get some numbers, not from the likes of NVIDIA, but Airbnb, Uber, and a reading from Caterpillar, which sometimes tells us something interesting about the global economy. And you wonder how that might land in a market that clearly is still nervous about US growth and the China growth story.
I'm going to do the one thing that I keep being told not to do, which is mention the Dow. And this is where the Caterpillar story is going to take a big hit because, of course, you know, when you see the headline, the Dow plummets, however many points it plummeted, 1,000 points or whatever, Caterpillar is going to be a big part of that story. So even if you do see a recovery trade in Airbnb and Uber, or even just paring back some of the losses, Caterpillar could weigh out of the normal in the Dow.
Uber and Airbnb, I think, are both really interesting. They're going to tell us a lot about the consumer. Yeah. I think that is what people are trying to figure out right now. The services data was strong yesterday.
Yeah, absolutely. Yeah, that's ISM, ISM services, which is where most Americans work, of course. Back to the job story. That is it for the opening trade. European equity markets bouncing back a little this morning. The Pulse is next.
What's happening on Wall Street?
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Great World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Well, European stocks bouncing back and U.S. futures higher after Monday's sell-off, capping a 3-week rout that actually wiped more than $6 trillion from the global equities. Now, a U.S. judge ruled that Google illegally created a monopoly off the search market by making exclusive deals worth billions of dollars with companies including Apple. Plus, Kamala Harris formally wins the Democratic nomination, the first black woman and Asian American to lead a presidential ticket for a major U.S. political party. So we'll have all the political news, but first of all, after the rout that we saw yesterday, let's take a look at the European markets map. Now, there is a lot more calm, certainly, than there was yesterday, and so there's this semblance of calm returning to the markets. We speak to a lot of investors that saying, look, they're looking for bargains, and other not so much. Now, we did see this $6.4 trillion retreat in global equities. That's over a 3-week period. Yesterday was pretty dramatic because it was a very big sell-off of a lot of risk assets. And you can see the DAX 40 probably one of the biggest gainers, 0.4% higher. Let's go straight to the futures in the U.S. because yesterday they finished the session on a 3% high. The S&P futures, you can see almost gaining 1%. The NASDAQ futures gaining 1.3%. Now, we're nowhere near where we were a couple of weeks ago, but again, this retracing back means that there is a little bit more, I guess, agnostic about some of the headwinds that were happening yesterday. Now, the Nikkei, probably one of the biggest losers yesterday, 34,675 currently. Some normalcy seems to be going back to the markets. It's very difficult to say after we saw from Citigroup and another couple of the big banks saying that they're expecting more from Fed. We wait for data. We did have an ISM figure yesterday that it was a little bit better than expected. So for all you need to know about the markets, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, European stocks rebounding. U.S. futures higher after yesterday's sell-off triggered by concerns about a U.S. recession. The VIX index of market volatility, though, remains at the highest level since 2020. Well, joining us now is Kim Crawford, Global Rates Portfolio Manager at JPMorgan Chase, and Bloomberg's Justina Lee. Thank you both for joining us. I mean, what a day. A little bit more calm than yesterday, but I still haven't figured out, Justina, what exactly the confluence of factors were that led to this. So I know it's the carry trade. That's more technical. There's, of course, concerns about AI and then concerns about a U.S. recession. But was there a real catalyst?
I think the catalyst was maybe the jobs report, and then Japan came in and panicked a bit. And right there were kind of also, how stretched the carry trade was. I think that really factored into the size of the sell-off in Japan. But I think a lot of that was just unwinding a lot of positions that people now think might be a bit overstretched. I'm talking about, long tech, long U.S. mega caps, maybe short vol. But I think other than that, I'm kind of skeptical as to whether the fundamentals have changed so much. And I think that's why we're seeing a bit of a rebound today.
Yeah, and I guess one of the things that, we're pointing to yesterday, Kim, that was working okay is that actually bonds behaved as they should. So if you looked at what equities and bonds did, I don't know whether it kind of goes back to a more normal market behavior.
Yeah, I think it's right. For us, the base case is still a soft landing. You talked about the labour market report triggering the big moves. But we think, there could be some noise in that data. Maybe the incoming data is going to show us more of that was noise around a still very gradually slowing trajectory. I think what's important for the bond markets and maybe broader markets as well is that the Fed is already very attentive to risks around the labour market. They've got a lot of policy space if they need to use it, especially since the disinflation narrative is firmly intact. And they will use it if they need to. I like to think of the analogy of a skydiver. You don't wait till you're less than 2,000 feet from the ground to really deploy the parachute. So I think if the labour market doesn't show, the broad mosaic of the labour market doesn't show any improvement by the September meeting, then a 50 basis points cut could be on the table from a risk management perspective.
So, Kim, how many interest rate cuts are you expecting overall? And there's quite a big chunk of the market that's still pricing in some kind of emergency meeting, and I don't know whether that sows panic in the markets.
Yeah, I really don't see the need for an inter-meeting emergency cut. I think the problem with that is that it really sends a challenging narrative for the market. It will fuel negative sentiment, and the Fed ultimately is data dependent, not just data point dependent. They're going to need a lot more labour market data in order to pull that trigger. And yeah, I think maybe, a really huge move in financial conditions is something that they will be attentive to, which causes an intermeeting cut, but it's not our base case, and we do think that they will wait for more of the data.
Justina, when you look at VIX, it still remains elevated. So again, we're off the kind of panic that we saw yesterday, but things aren't looking necessarily, that they'll go up.
Yeah, it was pretty crazy because at one point, I think the VIX actually spiked the most ever yesterday. And I think what this reflects is there are a lot of investors that are scrambling to add index hedges right now. And I think another dynamic here is that kind of before the sell-off, there were a lot of short volatility positioning. So maybe some of that was getting unwound, and that meant people were buying hedges again. But you're right. The VIX is still at the highest since 2020 today. And I think that just kind of shows sort of the level of concern still in markets right now.
So yesterday, we also heard from Mary Daly from the San Francisco Fed president, basically saying that the labor market is softening and indicated that the Fed should actually begin cutting interest rate in coming quarters. This is what she said.
From my mind, we've now confirmed that the labor market is slowing, and it's extremely important that we not let it slow so much that it tips itself into a downturn.
So Kim, basically, she emphasized that, she still sees strength in the labor market, that companies, have slowed their hiring, but they're not cutting jobs yet. So does that make it trickier to try and understand the strength of the U.S. economy?
Yeah, I think you've got to look at it in an aggregate sense. We speak to our corporate analysts daily, and the broad message from them is that there is a slowing that's well understood by the markets, but any sort of firing is going to be still a few quarters away, and a few quarters is really key. So we do think that you could see a bit of a recovery in the labour market. The payrolls print could be a bit of noise. And because of that, we do think our base case is about 50 to 75 basis points of cuts for the Fed this year.
So what does that mean for how you build your portfolio right now?
Yeah, so we've had a huge move in bonds. I have to say for the last few months, owning bonds, being in curve steepness, the risk reward looked good for us because they provided sizable income, and you own that entire tail of the labor market. Maybe the possibility of it loosening more non-linearly. But, the markets have moved very far, very quickly. We don't think the whole move has been purely fundamental. We talk about August liquidity conditions a lot, with a lot of risk takers on holidays. So we think here right now you've got to be patient and wait for backups and use those as opportunities to add back to those core positions.
I don't know whether it's unfair, Justine. The BOJ got a lot of criticism of what they did last week. I mean, they're also trying to kind of do their best. Is the criticism fair, and does it influence policy going forward?
Yeah, I think it's difficult, right? Because obviously it's unfair in the sense that a lot of this was a reaction to how stretched the carry trade was, and maybe a lot of the equity positions was. But I think that, I guess you could say that, should they have thought a little bit more about the market reaction? But I think at least, coming in today, I think what's going on is a lot of Japanese traders are looking at what happened overnight in Europe and in the US. And at least it wasn't as panicky. And that's why we're seeing such a big kind of rebound today.
Yeah, and there's a big meeting today, right, with the finance minister, the BOJ, and other officials.
Yeah, I mean, they're going to be paying attention to a lot of that. I mean, we also kind of had a bond auction of Japan today. Yeah. That was also showing pretty weak demand. And also they're going to be paying attention to kind of the violence of kind of these currency moves as well.
How do you play Japan right now?
Yeah, so we've had lots of volatility there. I think from here, probably what looks the most interesting is the curve flattener. We've taken out a lot of those hikes in the front end already. So if the global narrative does worsen, I think Japan 30-year yields at 2% doesn't make much sense. But I think if the global narrative at the same time calms down, we could get those hikes back on the table, and then the curve could bear flatten.
The other thing, Kim, that we haven't talked about yesterday in all of this panic is actually, does it change the market view for ECB and BOE, given the gravitational pull of the Fed?
Yeah, I think obviously, if we go into a big material U.S. slowdown, I think obviously straight away through the financial conditions impact, it does affect global central banks. But I think with the market calming down, our base case is still a soft landing. We don't think it's going to really change the narrative for the ECB or the BOE. Think consecutive cuts from the ECB possibility, but we think more quarterly still. The recovery in the growth narrative is definitely challenged, but not so that they need to go so quickly. And the BOE story is really tricky. I think the most interesting question there now is, are we going to get this growth boost from the new Labour government?
Yeah, many question marks, given we also spoke to Rachel Reeves yesterday, but we'll get onto the UK in a second. I mean, what are you looking for today, Justine? I know there's this, the Treasury is probably front of mind. Commodities. Yesterday, we were also talking about crypto.
Yeah, I mean, crypto was pretty crazy. Again, it was a reminder that, even after kind of all this talk about it being digital gold, at the end of the day, it's, so tied to risk sentiment. And so I think people are going to be paying attention to that. I mean, yesterday, we kind of saw a big risk-off rotation, into quality stocks, low risk, out of small caps. Is this still going to be the market action today? I think that's sort of another question.
Okay, Justine and Kim, thank you so much for joining us. Kim Crawford, Global Rates Portfolio Manager at JP Morgan Chase, and Bloomberg's Justina Lee. Now, coming up, Google is found to have unlawfully monopolized search in a landmark DOJ case. More on that next, and this is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
The conversations that matter, the insights you need. This is the Pulse, and I'm Francine Lacqua here in London. Now, we'll return to Kim Crawford from JPMorgan Chase in just a moment. But first, a U.S. judge has ruled that Google illegally monopolized the search market through exclusive deals with Apple and others. Now, Google plans to appeal the ruling. Let's get more on this and all things tech with our Tom McKenzie. Tom, I mean, this feels like a really big deal for Google.
It is a big deal. This is the first antitrust case, major antitrust case, against a mega-cap tech company in the U.S. for about 2 decades. And it's a win for regulators, for the authorities in the US. Now, Google, Alphabet say they will appeal, but it's very clear from this ruling, and I've read through it, the top line coming through, Google acted as a monopoly. That's very clear. It's written in black and white. They're going to appeal this, but what they come down on is essentially Google's exclusive deals with the likes of Apple and Samsung, the hardware makers, of course, to have Google's search engines the default search engine. That has allowed Google to raise prices for advertising consistently without facing that competitive threat. There's potential downside for Apple here because they won't get that revenue stream, because what Google was doing was paying about $29 billion a year to Apple, to Samsung and others to have this exclusive agreement to have that default search engine for those handset makers. So it's a potential loss of revenue for the likes of Apple and Samsung. And what could happen, and it's got another case that's going to come through in terms of how they rectify this, is they could be broken up. Google could be broken up from Android and Chrome, which would be very significant, or they could be forced to unwind some of these exclusive deals. So there's some question marks remaining, but the top line is this is a significant win for the US government in this major antitrust case. And again, Google, Alphabet saying they will appeal.
Yeah, so we'll see how this plays out. NVIDIA, I mean, this was one of the biggest stories of yesterday because it slammed so much after rising so much. What do we know today?
So the details around NVIDIA, I mean, the timing was just totally off, wasn't it? In terms of when this reporting came through, nothing that NVIDIA could have done about that, arguably. But at the time, of course, of this market rout, the news that NVIDIA is struggling to engineer the next iteration of its AI accelerator chips called the Blackwell. Currently, they ship something called Hopper, which is its AI accelerator, to their customers, who include, of course, Microsoft, Alphabet, Amazon, and Meta. They're coming through with the next iteration, and they're innovating around it, but it's hugely complex, and there are delays in terms of how they're building out these new chips within the Blackwell box of units they're going to be shipping to their customers in the second half of the year. NVIDIA say they're still on track for that. Analysts say don't panic. The revenue streams are still there. They still aren't able, NVIDIA, to actually match the demand. They're still not able to produce enough chips to match the demand. They see that going through 2025. But it's a reminder of the complexities of this innovation, and it's going to come down to timing around the fixes. So that's something that analysts say, watch the timing. Can they fix this? The bottom line is the demand for these chips remains.
Yeah, I mean, I was looking at the share price. If you look at over a year, I mean, it started at 40. It's now at 100. At some point, it was 140. So you kind of have to put the general context in longer-term share price. And then finally, Palantir. I think it's gaining some 11% pre-market.
Yeah, I mean, look, if you have concerns about whether the AI trade is continuing to work, and we had some question marks over the earnings that came through from Microsoft and Amazon last week, then Palantir has a clear run in terms of the demand that's coming through from AI. At least that is the takeaway from these earnings. And the CEO, Alex Harper, saying this is an historic. They've raised their outlook, and it's down to AI software around data analysis. They sell to commercial enterprises and governments as well. They saw an increase overall in quarterly revenues of 27% year on year. They've seen an increase for the commercial segment of about 33%, an increase of more than 20% for government. So the military and the Pentagon, big customers of Palantir, and they say it's about their AI software, and that demand has led them to raise their outlook.
Fabulous. You can see Palantir getting some 11.2%. What a terrific briefing looking at all things tech. Tom, thank you so much. Tom McKenzie there with the very latest on Google, Palantir, and of course, NVIDIA. Now let's return to Kim Crawford from JPMorgan Asset Management. Kim, when you look at some of the things that we were talking about, so we talked about the Fed, we talked about BOJ extensively. I mean, the BOE is in a little bit of a troubled spot, I guess, because so they cut for the first time. that was smooth, but then we don't really know what's in the budget from the new government.
Yeah, it's going to be a big piece of the puzzle. The way we think about it is always what's the net fiscal impulse of all the policies that Labour is going to announce. So Rachel Reeves has been really steadfast so far that she's going to stick to the fiscal rules. That means tax hikes are coming in the autumn budget. So net fiscal impulse should be pretty neutral, slightly positive, which small boost to growth, but nothing material that will change the BOE's course. I think the more interesting question for us that's harder to nail down is, are we actually going to get a sustainable boost to consumer confidence, to business optimism that will trigger investments? And I think a big wildcard as well is Labour's housing policy. Yeah. You know, loosening planning restrictions, but putting the burden on the private sector to really boost building and construction. And if that pulls through, then you could see a bigger impact on growth.
But, Kim, when do we, again, start knowing that there's always a bit of a timeline problem, that this actually takes a lot longer, which is why they have a 1-year spending review instead of like a 3-year one. See also what the OBR says.
Sorry, say again?
When the OBR, I mean, they kind of need to see what kind of growth and how much money they have left. So they're, I guess, in a wait-and-see situation for about 6-8 months?
Yeah, I think it's wait and see. I do think the autumn budget, you get those tax hikes with those new policies on spending. But I think the Bank of England, you know, I guess the broad fiscal room is still going to be quite tight unless you get a material move in bond yields or the growth picture changes materially.
Kim, thank you so much for joining us today. That was Kim Crawford from JP Morgan Asset Management. Now, coming up, we heard from Chancellor Rachel Reeves. She says the UK will strike the right balance at the budget, but she will not rule out increasing capital gains tax. So we'll have plenty more from our exclusive interview next. And this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Now, the UK Chancellor Rachel Reeves says she will not rule out increasing capital gains tax after warning that difficult decisions will be taken to fill a £22 billion gap in the budget. In an exclusive interview, she told us the UK will strike the right balance on tax at the budget in October.
I think people should pay their fair share of tax, and one of the challenges we have in the UK is a gap between what should be collected by His Majesty's Revenue and Customs and what is actually collected. But we made a commitment in our manifesto that we'll be sticking to, which is that we don't want to increase taxes on working people, and we will be keeping income tax, national insurance and value-added tax at the rates they are for the duration of this Parliament. I would like taxes on working people to be lower, but I believe that you can't make promises without being able to say where the money is going to come from. But the tax burden in the UK has got too high. The tax burden in the UK is at a 70-year high. I want to bring that tax burden down because I want to make Britain the best place to start and grow a business, and I want working people to keep more of their own money in their pockets, and that's what people will have with this new Labour government. And it's why it's so important that we grow the economy, because the last few years in the UK, there's been lots of debate about what level of taxation and what level of spending, but it's missed the bigger picture.
Yeah.
And the bigger picture is growing the economy.
Well, as you mentioned income taxes there, Chancellor, I wonder, given the revenue it potentially could generate, if you're tempted to bring capital gains taxes in line with the income tax, is that something you're considering?
We've got a budget on the 30th of October, and we'll set out our policy then. But it's always important when you're deciding tax policy to strike the right balance. Of course, you need to bring in the revenue to fund vital public services, but we've also got to grow the economy. And I won't do anything that makes it harder to achieve that economic growth and prosperity, because in the end, the only way we're going to lift living standards for working people and have the money that we need to invest in our public services, whether that is our health service or our schools or indeed our police and our armed forces, is by growing the economy. And so I am determined to ensure that when we set all of our policy, including tax policy, that we're not doing anything that will deter the investment and growth that we need to see in the UK economy. But we'll make decisions around tax and around spending at the budget and the spending review later this year.
That was the UK Chancellor Rachel Reeves speaking exclusively to Bloomberg. Now, the UK government says foreign states may be involved in fueling a wave of right-wing riots across the country. The Prime Minister, Keir Starmer, says they'll mobilize a standing army of police officers to deal with the violence. Now, the unrest has been fueled by online misinformation following the murder of 3 young girls last week. Starmer's administration has also slammed a post on X by Elon Musk that civil war is inevitable in the UK, saying there was no justification for the billionaire's remark. Coming up, stocks rebound after Monday's sell-off, but is this just a brief respite or a sign of things to come? More analysis next, and this is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. European stocks bouncing back, U.S. futures higher after Monday's sell-off, capping a three-week rout that wiped more than $6 trillion from global equities. A U.S. judge rules Google illegally created a monopoly of the search market by making exclusive deals worth billions of dollars with companies including Apple. Plus, Kamala Harris formally wins the Democratic nomination, the first black woman and Asian American to lead a presidential ticket for a major U.S. political party. So Monday's sell-off wiped $6.4 trillion off global markets in the last 3 weeks, sowing fears that it could be the start of a great unwind. Now, here's how Bloomberg guests have reacted.
The market got carried away by demanding intermeeting cuts. It's not going to happen. The Fed will look at the economy and say, yes, it's weakening, but this is not an emergency situation such as the ones we've seen before.
I wouldn't have expected the market to react with such a haste and panic the way it did. And so I think that the Japan story, the carry trade, is actually what's causing a little bit of chaos in the markets. And I think that, there really has been an immediate reaction to that.
We're getting closer towards the end of this kind of manic kind of price action because it was very much driven by technical factors.
It's good to see that today we have a rebound in the markets, and hopefully this breaks the fever. But I think we're still in fairly uncertain terms at this point in time, given that in some of the regional markets, we're actually still doing quite well on a year-to-date basis, and investors are sitting on profits might be taken to take some off.
Well, European stocks recovering slightly after yesterday's rout. The Nikkei in Japan ended the session up more than 10%. That's bringing Emmanuel Co. He's managing director and head of European equity strategy at Barclays. I imagine, Emmanuel, yesterday's a crazy day on the trading floor. I know there's a couple of factors. It's AI. It's, of course, the jobs report on Friday. It's a lot of the things that we talk about in terms of technical and the carry trade. But is this the start of something ugly, or is it more of a blip?
Well, we think it's more of a blip, Francine. I mean, the market was hit by the perfect storm. You have three main narratives going on. You have the recession issues, which was triggered by fairly soft data in the U.S. and some cautious commentaries from companies on the U.S. consumer. You have this unwind of the JPY carry trade, which has broad ramification for risk assets. And then you have this kind of concern about AI and the hype around very well-owned names. So all this happening in August probably was creating this stress in the market. You have very low liquidity, very low attendance, and we've seen some, I think, exaggeration of the growth curve. Look, I think the erratic price action might persist for now because not all this leverage position have been clear. I mean, when you see VIX going up as much as it did yesterday, you would expect some damage. You would expect some leverage position to get hit and triggering more unwind. So I would expect the unwind of some of this position to carry on in the next few days. And look, you still have a fairly uncertain outlook with mixed earnings, mixed macro. You have the US election in sight as well. So all this, I think, will contribute to persist and angst in the market, but we don't buy into this growth scare. We don't buy into the hard landing scenario, or view that the soft patch should not be misinterpreted and taken for as a recession, and we would expect some stability to resume at some point.
So, Emmanuel, what's the next catalyst actually for some of these European equities? Is it still the Fed because of the gravitational pull of the Fed? And from what you're saying, you're not expecting an emergency meeting where they cut this week.
Look, I think it's more about the data than the Fed. I mean, we don't buy into this kind of recessionary concerns, but look, some of the data flashed right last week. So yesterday, ISM services were a step in the right direction. We had a bit of a pickup in services and employment, which was important. I think jobless claims on Thursday will be also quite important. You don't want to see more weakness in the labor market. And I think the next big thing would be the US CPI on Wednesday next week. Obviously, if you see a bad surprise and a hot CPI, that might put into question the Fed cut, which are priced in. Now, I think there's a very high bar for the Fed to cut between meetings. I don't think the Fed has a reason to respond to this market stress. Fed has to tolerate some degree of stress in the market, but we don't see a meaningful issue that will put the financial stability into question right now. So I think the Fed should wait for September to cut rate, and I think Jackson Hole will be the next catalyst where we would expect central banks, whether it's the Fed or the Bank of Japan, to tell us how they are going to process from here.
So, Emmanuel, a lot of blame has been done, actually, in the BOJ, and I don't know whether, again, it changes the way that you view policy in Japan going forward, and therefore that impacts European equities.
We think here that 145 is much closer to fair value, probably much closer to what the Bank of Japan had in mind. I'm not really sure the Bank of Japan will tolerate a much stronger yen here, which I think would start to be an issue for Japanese exporters in particular. Right? I think the Bank of Japan communication will have to be adjusted accordingly. And again, on the other hand, we don't buy what the market is pricing in for the Fed. We don't buy the bit that the Fed is going to cut 5 times by the end of the year, which seems to be too aggressive to us. So I think yen between 145, 150 should be the new range. And if we manage to stabilize, I think that might help stocks finding a floor. Yen has to stabilize for risk asset and equities in particular to stabilize as well.
Is this the right time to go bargain hunting? And if yes, are there specific sectors that could be a good opportunity right now?
Yes, we think it is the right time to go bargain hunting, more at the stock level than at the broader market level. But I think some of the derated quality cyclicals that have gone down in sympathy with the broader market, maybe because of positioning, look interesting. I would think that things like, part of tech look quite interesting to us again. Some of the banks, which went down a lot in the last couple of days, look interesting. Some of the industrial names, we still like, a number of defensive sectors like utilities as well. So we want to hold a fairly balanced portfolio. We cut risk before summer on the view that the risk reward was getting less favorable. We stick to this view. We don't want to be too risk on into the fall. But look, you have to listen to the market and you have to use opportunities when they arise. And we do think that tech, among other things, look quite interesting at those events.
Emmanuel, what do you do with tech overall, though, at the moment? And again, it's, I know there's questions on NVIDIA. That was maybe unlucky because it was a market sell-off. But we also had Warren Buffett cutting half of his stake in Apple. Again, is it a coincidence, or are there bigger question marks about the rapidity of AI and what that means for some of the European providers?
Look, the bar for positive surprise is much higher now for the broad tech and AI space. It's very hot. It's quite crowded in some cases. And market wants to see the money. Market wants to see the numbers. Look, the reporting season was a bit of a mixed bag. But generally, we are still seeing AI spending trending upward, and that should support some of the names like SML, which as a house we turned overweight on very recently. We used a dip to buy SML last week. We think NVIDIA should still deliver relatively good guidance into next year. So again, I think the market will need to see more fundamental from here. And I think NVIDIA earnings on the 28th of August will be quite important. But look, ASML down 30% from the rise, it seems a good opportunity to us because we think the broad AI story is still very much intact.
Emmanuel, what's your take on the UK? So we spoke to Rachel Reeves in the US yesterday, and again, she declined to rule out an increase in capital gains tax, but her strategy seems to be well laid out.
Look, I think you have two main stories for the UK. You have the FTSE 100, which is an index that has benefited from this risk of and flight to safety because the FTSE is underweight tech, is a very defensive index. So if you need to hide somewhere, the FTSE 100 should do the job. Now, the more domestic part of the market is where we think there's a bit of a more long-term story in terms of policy growth, mix improving. We think political visibility and the prospect for Bank of England to cut rate more down the road should help to restore confidence in the UK economy and to attract foreign money back into the UK. We are seeing strong interest from global investors towards the UK. Valuation are still looking very, very cheap. And we do think that the case for bounce in the economy on the back of this improving growth policy mix should help some of the under-owned part of the market, whether it's some of the banks, some of the house-related names, some of the consumer names, staples, food retail. So we quite like some of the names there, but we're obviously selective on what to buy.
Emmanuel, thank you so much. Emmanuel Coder, Managing Director and Head of European Equity Strategy at Barclays, joining us on the back of this big sell-off yesterday. Now, coming up, we talk U.S. politics. Kamala Harris clinches the Democratic nomination, setting up a November election against Donald Trump. More on the race for the White House next, and this is Bloomberg.
What's happening on Wall Street?
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
Welcome back, everyone. Now, Kamala Harris has formally clinched the Democratic nomination for president after winning a virtual roll call. Next up, a decision on her running mate. Now, let's discuss all of this with Bronwyn Maddox, Chief Executive of Chatham House, and Rosalind Matheson, our Bloomberg's EMEA News Director. So thank you both for joining us. Bronwyn, let's start with you. What's the next step for what Kamala Harris needs to do? So, of course, there's a running mate that she needs to pick. Does that person need to go after a different demographic to what she appeals to?
I think the focus now is on the
how that running mate, that choice of running mate, plays in some of the key states that are really going to determine this election. And that's why everyone has been looking at Josh Shapiro, governor of Pennsylvania. Very hard to see how she wins without securing Pennsylvania. But of course, you have the Mark Kelly and the Tim Walz calculations in there as well. I think it really comes down now to that microscopic analysis of what the running mate does in those states and what it also does in the broader message about the party. Josh Shapiro is acclaimed to be represent the future of the party. Older candidates, not so much. So, it's down to all that. I must say, from the perspective of other countries looking at this, and I'm speaking from London, they're really just focused on the tightness of the presidential race. So the vice president matters less, except how it determines those chances in the end.
So, Roz, how do I look at the polls? Again, there are a number of polls, and actually, speaking to people, they say, well, is the U.S. really ready for a female president? But then the polls suggest that she's doing quite well in the swing states, but we're exactly almost 4 months away per day to that election.
Well, that's right. So she's had a bounce in recent weeks, and now, of course, when she was the presumptive nominee, now she really is the nominee, and she's had a bounce. There's a lot of money flowing into the Democratic coffers as a result of that. The question is, how does that last? Does it last? How does it translate into particular states? As Bronwyn was saying, the VP pick matters in that numbers game, and then they're going to both be out campaigning. And once she's on the road properly campaigning, how does that look like in terms of her numbers? Do they hold up in those key states? Does her VP pick help her in that? Does Trump, bring some of those gains back? The concern is, does she have this early momentum now? But, the coming months when she's on the road campaigning, potentially debating Donald Trump, also, does that lead get chipped away again? It's really within the margin of error at the moment. So it's pretty tight.
So, Bronwyn, who's she polling well with? Is it, the young folk because of her memes, and actually she got endorsed also by a very popular UK rapper? Is it, the Black Caucus, and where does she need to work?
It is some of each of these, and I think some of the strength in those groups you've mentioned has taken her own campaign a bit by surprise, and certainly taken the Trump campaign by surprise. So it is where she can make inroads into the support that Trump appeared to be getting. But of course, Trump is not neutral in this. He's done his part in the past week or so to jeopardize his support among the black community with some of his remarks about now very well covered interview with black journalists. She's just probing for weaknesses there. And I think it really comes back to the swing states. So it is what really matters there. That's where some of the debate about Josh Shapiro comes in, because they're saying, does his support for Israel compromise her ability to appeal to those, not just Arab Americans, but those who are critical of Israel's actions against Palestinians?
Roz, at the same time, and we'll get into policies in a second, it does seem to have energized, right, the Democratic camp in general. I mean, they saw a record number of donations, I think some 310 million just for the month of July, and there's many more volunteers. Does money really matter 4 months before the election?
Well, it certainly does matter. It matters particularly, again, for those swing states and for advertising, because you need to, blitz the airwaves with TV, on social media. So really it's going to help her campaign in those swing states, depending on where those funds get diverted. But as you say, it was really also a factor of, again, in a way, that sense of relief for the Democrats that Joe Biden made that decision to step aside as the candidate for 2024, to give her that runway to build momentum for her campaign. There'd been so much talk for weeks and months about his health, whether he'd be able to sustain, the election another term as president. So you got that relief sense that came in, and a lot of money coming as a result. Again, the question really is, how do you sustain that into November?
And again, one of Bronwyn's very good points is that when you look at policy, what are her stumbling blocks? Is it, Israel, Gaza, immigration, which is really the portfolio that she was in charge of?
Well, a lot of Americans vote on, like many countries, bread and butter issues primarily. So it's the state of the economy, it's wages, inflation, their own sense of their own personal circumstances. And she's vulnerable there on several issues. She's not really being tested on economic policy. That's been the domain of Joe Biden and others. She was also assigned that very tricky portfolio in a way of migration from the outset, and how you don't, navigate that without falling into difficulty. And she has. It's really an impossible portfolio to have, and so she's quite vulnerable to attacks from Donald Trump on that front. Where she can come back, of course, is on things like abortion, where she's been very, very forceful, and that could be a good vote winner for women as well. So she does have some advantages on policy, but also she's going to be tested on how she would drive the economy if she were president.
Bronwyn, how's the Trump camp actually organizing themselves? I know that there's been a lot of focus on Senator J.D. Vance of Ohio and some of the past things he said.
Absolutely. He looked like a very strong pick for perhaps the first 48 hours. Many people thought, look, here is someone, a younger Trump with longer and sometimes better words than Trump has himself. And then the extremity of some of the things that he was saying, his potential to alienate voters, also came into the spotlight. So, he's not a neutral factor. But the Trump campaign has seemed disconcerted by the momentum behind the Kamala Harris campaign, really disconcerted by the swing of attention from Joe Biden's health to suddenly this younger candidate. Now, if she is going to turn this round, she does need to address those two things that we were just talking about, the economy, but she can point to the rate of economic growth, which I can tell you many other countries would be very envious of, particularly those in Europe. She can point to the growth in jobs, even if that is slowing at the moment. And she can also say, even if it sounds a bit defensive, look, I didn't have the whole immigration southern border portfolio. I had a roots portfolio trying to deal with the causes in those countries. This is my strategy for dealing with that border. And now let's talk about whether it's abortion or the strength of the economy compared to much of the rest of the world. So there is a way in which she can play it. But she has to make sure that her vice president is speaking to the same script.
Roz, when you look at the Trump camp, first of all, does the presidential debate actually weaken him? And I know there's been, his vice presidential pick is really mocked online, but Trump still continues to pull ahead of his numbers from 4 years ago.
Well, that's right. The question is, will he face her in a debate? He's been a bit defensive about it, a bit coy about it. As Bronwyn was saying, he's probably a bit spooked about the fact that he no longer has the issue of Joe Biden's health to really campaign on. He also has to campaign on some sort of agenda, at least. And we don't know how they'd go head-to-head in a debate. I mean, she's a prosecutor. She's very good in the minute. He is also, a pretty good debater, mostly because he just steamrolls over his opponent in the minute and just sticks to his big points, his talking points. So it'd be interesting to see them in a head-to-head. But she could hold up pretty well, and that's why we're seeing all this dance around will they or won't they debate, and that would be a really key moment in the campaign if they do.
Rosa, thank you so much. Chatham House Chief Executive Bronwyn Maddox and Bloomberg's Rosalind Matheson, of course, on the implications in the U.S. Now, coming up, Aramco keeps its $31 billion dividend despite reporting lower profits, so we'll have plenty more on the oil giant's earnings. This is a Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Well, Saudi Aramco has maintained its quarterly dividend at $31 billion despite lower profit. Now, the payout from the world's largest oil exporting company is key for Saudi Arabia as crude prices remain far below the levels it needs to balance the country's budget. We're now joined by Bloomberg's Jumana Bersace. Jumana, thank you for joining us. So how do these results actually compare to expectations?
Yeah, well, you're seeing a positive price reaction in the stock this morning, Francine, which tells you that they are basically in line with what the market had penciled in. Net income about 3% lower year on year. Revenue slightly lower than analyst estimates, but a lot of takeaways have come through from these earnings. Namely, they are seeing some of the positive tailwinds that other names in the sector are reporting. That is to do with pricing power. Obviously, the price of oil for the quarter was higher this year than it was a year ago. That has helped the sector as a whole. But specifically for Aramco, one thing is pushing these results down, and that is the fact that they have lower production. They are pumping 9 million versus a maximum capacity of 11 million barrels per day. That is posing a bit of a headwind to their overall revenues. In addition to that, much like other names in the industry, they're seeing some pressure come through on their refining margins. But the Aramco CEO has just said that he doesn't expect those pressures to continue into the third quarter. Finally, and probably the most important thing for investors and for the Saudi government, they have maintained that dividend payment of $31 billion for the second quarter. This despite the fact that net income has dropped about 3%. And of course, it is a crucial source of funding still for the Saudi government, which has about a 97% stake in Aramco.
Jumana, thank you so much. Jumana Bersace there, Bloomberg Horizons Middle East and Africa anchor. Now, very quickly, let's just look at some of the U.S. futures. A lot going on after yesterday's sell-off. So for the moment, we're seeing gains across the board. S&P futures gaining 1%, as is the NASDAQ. Here in Europe, we're seeing indices gaining 0.4%. So we're certainly not recouping some of the terrain lost yesterday, but there is a lot more normalcy returning to these markets. Up next, Bloomberg Brief with Manus Krani in New York, and this is Bloomberg.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
Was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning from our global headquarters in New York. I'm Manny Scranny. You're welcome to Bloomberg Brief. Let's set your agenda. Global equities stabilized for now. Japan leads the rebound, with the Nikkei jumping more than 10% after a tumultuous 24 hours. Still, investors question the scale of the carry trade unwind as Japan's top currency official says the BOJ, they're closely watching and monitoring markets. And Aramco keeps its quarterly dividend at $31 billion despite the lower profit as Saudi Arabia faces a budget deficit. Are you nervous? Do you trust this recovery? Mild as it is, we've come off the highs of the overnight, but there is a moment of stability here. Spoos gave back 3% yesterday, the biggest drop in 2 years. Goldilocks has been served some toxic porridge. The question is whether this is a 1987 style sell down or 2000, 2008. It is not. The consensus is landing on 1987, which was a 3-month, quite a dramatic drawdown in equity markets. The Nasdaq rallying by 0.7%. There will be no peace in these markets until dollar-yen stabilizes. 2-year yields, by the way, I want to give you some context. 2-year yields traded down to 364 yesterday, rebounding 396 this morning. That's a move higher at one juncture by 35 basis points. An inter-meeting cut frenzy that we had yesterday. State Street say this to me: you're crazy to think that the Fed would respond with an inter-meeting cut of 50 bips to a bunch of crowded, over-levered trades in FX, equity dispersion, vol premium harvesting, and AI FOMO. I show you the Asian session. This is where the yen has rallied by 4 big figures overnight. They are on intervention watch in the other direction. Mamura, the top currency official, say the government, the BOJ, are working closely together. The Nikkei managing to turn it around by 10% after tumbling more than 12% yesterday. So outpacing their Black Monday crash of 1987 and turning it around. Is the carry trade done? There's one man with the answer to that and some perspective to the Asian trade. Mark Cudmore joins me now, our Bloomberg macro strategist. Mark, good to see you. So the whip around in the equity market is there, yen is ascending, and we are on I would say we're on verbal intervention watch in the other direction. How much of the carry trade is unwound? Good morning.
Good morning. I think there's a large amount of it. I think there's basically two types of carry trade. There's the short-term kind of day trader, hedge fund carry trade. That carry trade has pretty much blown up. In fact, a lot of it was already taken off even going into the BOJ last week. The rest has kind of been cleaned out. Sure, there might be some lingering CTA positions out there that still need to be squeezed, but that's not the problematic carry trade. There is still a very large structural carry trade overhang of short yen positions that come from those kind of real money or those kind of structured notes or real estate developments. Many of those positions will be held in private assets. They'll be held by high net worth individuals. They'll be held in products that may not mark to market so regularly, and therefore the full kind of losses and extent may not be realized later on in the month. It may take a couple of weeks or months to be kind of to be taken out, if it indeed gets taken out. I think this is an important aspect. While there is still a massive structural overhang of long-term borrowing in yen to buy other assets around the world, it doesn't necessarily mean that it will get cleaned out just because the BOJ has hiked rates. I think a lot depends on what your global macro view is. Do you think the Fed really is going to cut rates aggressively? Do you think that the US is going to hard landing? If that's the case, then the dollar-yen trade probably continues, and that will probably squeeze through on the yen on the crosses as well. But there's another narrative out there that we're suddenly panicking about the US economy. We're suddenly panicking about a hard landing that no one was kind of anticipating only a few weeks ago, just because of a few weak prints. We're still adding jobs in the US. ISM still strong. So I think that perhaps the hard landing fears in the US are overdone. If that's the case, sure, we might have markets correct for another few weeks. I don't think the pain of this week, the last few days is over. I think in the next few weeks, August, we'll see more markets pain. But there's a chance that by September, we're trading a different narrative again. BOJ has realized their mistake, and maybe we go back into a yen depreciation trade, and those long-term structural yen shorts never get cleaned out.
Okay, as you say, Mark, you know, the wonderful thing about the foreign exchange market is that it is OTC, and so understanding the size and the scale of that carry trade is somewhat like sticking your finger in the air until you get the data later in the week. Mark Cudmore on the latest overnight in Asia. Sharon Bell is the Senior Equity European Strategist at Goldman Sachs. Sharon, good morning, good to see you. If I go back 24 hours ago, there was a certain irrationality and panic to these markets. Friday growth scare, yesterday the Fed behind the curve. So do you, when you listen to Mark talking about the context of the carry trade, how much blame do you apportion to the unwinding of a carry trade to these quite aggressive panic-like moves in equities?
I think I would apportion a lot of the blame for the very large sell-off we saw in the indices in Japan to that move, because of course Japan equities are super correlated with the yen. The weakness of the yen was much of the reason for the strength of those equities in the last 12 months or so. So when you see that flip, then you do see this very, very aggressive move. So absolutely, I blame it for that. But I think it's not entirely driven by that. I think it's also driven by, you know, the slightly weaker data we got out of the US, concerns, as you say, about recession, valuation of the US market. So it's not solely that carry trade.
No, it's not, but context really does matter. I know we say it every day when we go to commercial break, but it is about context, and this is what I want to understand from you. If I look at the post-COVID inflation scare, markets drew down by 23%, global financial crisis down by 56% over 17 months. But I go back to 1987, there was a 30% drawdown, and it was 3 months, and there was no recession. The context of this repricing, and I think that's what market participants and investors are trying to get their hands around. It's not whether the selling is done, it's whether the context of the floor has been put in. And I think we still have a ways to go before we reassess whether this drawdown is done. Would you agree with that? Is this looking more like 1987 than GFC?
Yeah, I mean, there are, of course, no perfect parallels historically, is there? But I think the GFC was a recession, and a global recession, and a very deep one, and we're certainly not looking for that. So I wouldn't see parallels with that. 1987, therefore, has slightly more parallels. But again, very, very different. I do think that it's not isolated to Japan, clearly, but the big fall was happening in Japan and was happening by this sort of crowded positioning. It's similar to 87 as well in that the market had done very, very well in the last 12 months. You take something like the NASDAQ, for example, was up 50% since October last year. Global equities up 30%. So that just always makes you more vulnerable.
Yeah, and I mean, even if you look back at SVB, I was on a call yesterday with a wealth manager, and he's saying, look back, man, I said SVB, the market was trading 3,800, 3,900, and you have had this massive uplift since then. He basically said, stop whining about 500 basis points. I think he's perhaps more of a veteran than I am. Let's talk about the framing of the narrative. Yesterday, there was quite a hysteria about a bane for the Fed to do an inter-meeting cut, and people were saying, you know, this is what we need. I'm talking to Tim Graff this morning at State Street, and this is what he had to say. It's crazy to think that the Fed would respond with an intermeeting ease of 50 basis points because of a bunch of crowded, over-levered trades in FX carry, equity dispersion, vol premia, harvesting, and AI FOMO. I mean, I call that visceral, but how does the Fed frame the potential next move? Because the narrative is, oh, if they go for 50, it really is panic and global growth scare vindicated. How do they frame the cut? And contextually, can you at Goldman see 50 basis points? I know it's part of your call, you see a recession, but how do they frame this cut, Sharon?
Yeah, look, I mean, I probably agree with most of that statement. I feel that the Fed is not there to sort of save particular positions if they go wrong. The Fed is there to consider inflation and economic growth in the US. Economic growth, and the data has been more mixed more recently, that's for sure. The manufacturing side of the economy has been quite weak. The most recent payrolls data was on the weaker side. We've added in an extra cut in our forecast for the Fed, but we still expect them to go only 25 basis points in September, November, December. We're not looking for a big cut at any point. We just don't think the economy really warrants that at the moment. So yes, I think that there would be a point where the Fed would consider it, but we are far from that at the moment.
Let's get down to brass tacks then. I mean, we've had a moment of reflection, one could say, in the Mag 7 and on AI. We've been swooned into Russell and then slapped in the face. So where exactly how do I look at these markets? Do I see this as an opportunity to buy the dip? I kind of loathe that phrase. How do I look at this? I had somebody call me yesterday explaining dollar averaging to me. I said, it's okay, I know what it is. So give me your perspective in terms of what I do right now. If I'm fully invested, I'm long risk, I'm long equity, and I have a reasonable 60-40 portfolio.
I mean, look, actually, on that last point you make, 60-40 portfolios, they have done okay, I guess you could say, in this sell-off. Whereas in the previous sell-offs, the last few years, they suffered because bonds fell at the same time as equities. This time, the bond market rallied and yields fell because people worried about growth rather than inflation. So actually, for a 60-40 investor, I think that sort of 60-40 split makes quite a lot of sense at the moment. I do think there's a risk this correction continues. You get a more volatile August, etc. That's always tricky for investors. But if you've got a long-term hat on, if you can weather this for the next 6-12 months, then I think that actually equities give you reasonable returns, but not the returns that we've had up until sort of July for the previous year, where you had that 50% rise.
It's good to hear that the 60-40, finally 60-40, you know, behaving, bonds are behaving as the asset, as the haven asset as they should be. I look at the short end of the curve. I look at that really momentous turnaround yesterday, 34, 35 basis points on the short end of the curve. If you're smart right now, should I be buying, if not protection or put options, and the volume of those are high, they're expensive, perhaps relock and reload at the short end if the hedge of hedges is actually working as a hedge in the short end of the curve?
Yeah, I mean, there's lots of things that you can do here. I think that you could consider, I do feel the market is now pricing a greater risk of recession, a greater risk of declining rates than we would expect. We think the data has weakened ever so slightly, but really not very much. We think that the underlying jobs picture in the US is much better, and the Fed won't need to do any emergency cuts. And that therefore yields at the short end will stay a little bit higher, if not go pricing a little bit higher from here. So, you know, those short-term interest rates, that short end of the yield curve for investors may look a little bit interesting. But generally, I think this brings home this argument of you don't want all your eggs in one basket when you're investing. You want to diversify. You don't want everything in the Japan carry trade. You don't want everything in the Mag 7 or US tech. You want to have a diversity in your portfolio, including, and we've just discussed it, why 60-40 portfolios are also doing reasonably well at the moment, because bonds are buffering you against the sell-off in equities.
Sharon, You've just built the conversation for later on in the afternoon with the wealth manager, Sharon Bell of Goldman Sachs. It's not time to sort of do anything radical at the moment. There are other stories trending on the Bloomberg terminal this morning. Let me run you through them. The U.S. safety investigators kick off 2 days of hearings today on Boeing's panel blowout accident. Executives for both Boeing and Spirit Aerosystems will testify. The hearing comes 7 months after the 737 MAX lost a fuselage panel during a flight. NVIDIA CEO Jensen Huang sold a record $323 million worth of shares in July, just ahead of the wider tech sell-off. Combined with the shares he unloaded in June, Huang has sold nearly $500 million worth of NVIDIA stock. The Korean chip company SK Hynix is set to receive $450 million in U.S. grants and $500 million in loans to build a facility in Indiana. The award is the 15th agreement the U.S. has made under the CHIPS Act. SK Hynix's customers include NVIDIA, Apple, and Microsoft. Coming up, Aramco is keeping the $31 billion dividend alive. This, as Saudi Arabia is pushing a multi-trillion-dollar economic makeover plan. More on the matters on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Brief. I'm Menace Cranny in New York. The earnings are coming in this morning in the Middle East. We have Aramco maintaining its dividend of $31 billion. That's despite posting lower quarterly profit as Saudi Arabia faces a budget deficit in the coming years, keeping the 2030 dream alive. Jumana Basechi keeps the dreams alive every day on Bloomberg Horizons in the Middle East and Africa. Jumana, when we look at these numbers from Aramco, what goes through my mind is the deal that they signed with the OPEC Plus members, which was to cap the production of Saudi at 9 million barrels. And that is coming home to roost in these numbers, I suspect.
Yes, absolutely. And yet, despite that, they had a decent quarter coming in line with analyst estimates. The stock is up 2.6% in reaction to these results. Net income down about 3% versus a year ago. So managing to keep up the net income despite some of those headwinds that you speak of. So yes, even though pricing is more favorable, oil prices are higher for the last quarter than where they were a year ago, oil production is an issue. As you rightly point out, Aramco are only pumping 9 million barrels a day versus a full capacity of $11 million in reflection of those OPEC Plus production cuts. So obviously that's going to
weigh on the bottom line there. The second downward pressure is coming from refining margins, and that is not specific to Aramco. It's a reflection of the industry as a whole. That the Aramco CEO said that he expects some of those headwinds to subside in the coming quarters. But the key takeaway here, Manis, is that even though we are seeing somewhat of a moderation in net income, they have maintained that dividends at $31 billion for the quarter, a key point for investors here.
And to that point, Joanna, the CEO on the tape just before we both came to air, the performance dividend is a permanent part of the calculation. They've had a second tranche of equity launched this year. Is that dividend payout to keep the new institutional holders on side? And a lot of them are here in the US.
Yeah, so let me point out one thing. First of all, relative to all of the other oil majors, Aramco pays the highest dividend yield. It's got a 7% dividend yield. And when we spoke about the allure of that secondary share offering that came out a month ago, foreigners were actually eager to get involved because of the very attractive dividend payout. And so for foreign ownership, it's important to continue paying that dividend, but even more so important for the Saudi government. Don't forget that the Saudi government still has a 97% stake in Aramco via the central government and PIF. And so for the Saudi government, it's become a very important source of funding. If you take that away, clearly it's going to weigh on the Saudi budget as well. One final point is dividend payout of $31 billion, free cash flow of $19 billion. This means that in coming quarters, you can expect that net cash position to continue dwindling further. So something to bear in mind.
Okay, certainly a hard balance in ag stocks, down 19%, underperforming some of the other majors. Joanna, thank you so much for the Aramco numbers. Let's pivot to the tech sector. Stocks might be bouncing back, but there is a sector which still has other issues to contend with. A U.S. judge has ruled that Google illegally monopolized the search market through exclusive deals with Apple and others. Google plans to appeal that ruling. Tom McKenzie is tracking the story. I mean, this is history in the making. It's been a long time since the courts have won against big tech. How significant is this for Alphabet? Tom, good morning.
Yeah, you rightly touch on the timing there, Manis, because it's been about 2 decades. Here's the top line that stands out from this ruling, from the judge that you cited. And this is, and I'm quoting from this ruling, Google, I quote, is a monopolist and it has acted as one to maintain its monopoly. This is about, according to the ruling, these $29 billion or so annual payments that Google makes to the likes of Apple and Samsung to have this exclusive deal to ensure that their search engine is the default search engine. And what does that allow Google to do, according to these findings? Is allowed them to raise the prices of advertising without facing a competitive threat. Next steps, potentially, we're going to get a hearing in about a month's time. That's going to happen. Then they'll set the dates for another trial that will look at how Google rectifies this. That could mean splitting the search business, Google search business, from the likes of Chrome and Android, or it could mean that they are compelled to unwind these exclusive deals with the likes of Apple and Samsung. But as you say, this is significant. Google, Alphabet saying they will appeal this finding.
Timing is everything on the news release that you sold some of the stock of which you're a CEO. I'm talking about Jensen Huang. Selling nearly $500 million worth of stock in the last 2 months. You can look at this a couple of ways. You can't blame the guy for selling some stock. He's been fully invested there for a long time. Relative to, we've had a little bit of a shakedown, but there's other news flow there about the rollout of one of their new AI chips as well.
Yeah, which I think arguably is more significant. I mean, Jensen Huang, he set out this plan to sell down part of his holdings through this year up until around July, and he sold down about 500 million in the last few months. But that plan was set up in the early part of this year. So yeah, big chunks of money have of course been unwound relative to the value of the stock. Not very much, but for Jensen Huang, he'll take that home. But in terms of the engineering challenges, I think arguably more important, this affects the Blackwell suite of chips that are meant to take over from the current one's Hopper. Analysts say, look, it comes down to the timing around how they fix these and how they ship these to customers. But the fundamentals, according to the analysts we've been speaking to, remain for this business. But some engineering challenges, speaking to the challenges around innovating in this space.
Tom, thank you very much. Stock down 10% there, as you can see. Tom McKenzie on the NVIDIA story and beyond. Context matters every day from New York on Bloomberg Brief.
times in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Page news for you from around the world. First up, Politico reports several U.S. personnel are injured in a suspected rocket attack at an airbase in Iraq. Now, the attack comes as Israel and the U.S. are deploying more forces to the area. The region has been on edge following the assassination of Hezbollah and Hamas leaders last week. Next up, the FT. Let's run with that. Rioters as young as 14 appeared in a UK court on Monday. Now, this is as the government promised that those involved in the recent violence and unrest will face, as they say, swift justice. The Prime Minister, Keir Starmer, vowed to ramp up criminal justice. And OpenAI President Greg Brockman says he is going on leave until the end of the year. Meantime, OpenAI co-founder John Schulman is leaving for rival AI startup Anthropic. Now, the move follows significant churn among the OpenAI management this year. Checking out on your tech trades this morning. This is how some of the Mag 7 are performing. You have a number of stories around. This is the performance over the year to date. You're still in the green on NVIDIA, up 124%.
In terms of how we should deal with the challenges that are, facing the world and also internally, I think it's just an opportunity also, an angle. And you could see that in a lot of activities that are picking up in this region, simply because it's a region that is actually a bright spot amongst very few in the world today. And people always talk about the flavor of the month. Actually, I don't want to sound too, large-headed, but actually we will be the flavor of decades. We are determined, we have long-term plans, and we are very clear and committed on our commitment to the investment community at large. I'm not talking about one individual country, but at large in the GCC, that we mean business, that we are willing to take every step possible to make it easier for investors to do business in the region, that we are willing to do a lot of structural changes, including actually making it very predictable, very consistent policies.
Global headquarters in New York, I'm Manus Granny. Let's set your agenda on Bloomberg Brief. Global equities stabilized for now. Japan leads the rebound with the Nikkei jumping more than 10% after a tumultuous 24 hours. Still, investors question the scale of the carry trade unwind as Japan's top currency official and the BOJ say they're closely monitoring markets. And Aramco keeps its quarterly dividend of $31 billion despite the lower profit. Saudi Arabia faces a budget deficit. Good morning. You can all breathe easy. Japan managed to rally by over 10%, and so there was some kind of a recovery phase narrative to the U.S. equity session. We have come off our high since I came in at 3 a.m. You're looking at a global wipeout of $6.4 trillion globally over the past 3 weeks. Context matters. Are you looking at a 1987-style drawdown? Goldman Sachs say, look, it's hard to find a similar situation, but that's probably the most relevant context for you. There'll be no peace in this market until dollar-yen stabilizes. And to a certain extent, the dollar has rallied a little bit overnight by by four big figures. But that carry trade unwind, there's still another leg of it to go, according to Morgan Stanley, another $80 billion to go. Keep an eye on the very short end of the curve. We just had a conversation with Goldman Sachs, a 60-40 portfolio. Hello, it worked very well in this wipeout. The bonds acted as a haven, especially at the short end of the curve. Twos traded down to 364 yesterday, back to 399. We seem to have stepped back from the rabid calls and probabilities for an inter-Fed meeting cut. That seems to have dropped off. That frenzy seems to have dissipated. We did have a disinversion in the curve 2s, 10s, and that really gave it a whiff of panic. Let me just show you what the Mag 7 are doing right now, or some of the components of the Mag 7, I should say to you. NVIDIA popping by 1.25%, despite Jensen Huang selling some stock in a delay. The delay on the AI advanced chip was news yesterday. We're bouncing this morning overall in tech. Microsoft up 0.7%, and Alphabet weathering the ruling against them at the moment on search engine. So we've talked about the carry trade, the size, the scale, and the torch that it lit under the the selling and the deleveraging that we saw. Paul Dobson is our executive editor for markets. And Paul, good to have you with me. So we have this moment of stability, one could say, but hardly a floor. The question for markets is, to what extent is the carry trade fully responsible for yesterday's carnage following the growth scare on Friday?
Yeah, that is a really good question. I'm sure that it definitely played a pretty prominent role. One of the last cheap places to borrow in the world is slowly taking away the punch bowl, right, with the Bank of Japan raising interest rates. And that really has given people some cause for concern, caused a big retrenchment, and that's why we've seen the yen flying stronger against the dollar at long last after, so much depreciation. Like a big coiled spring, and hence that really big kind of repercussions and fear that it's spread through the rest of markets. And I think as well as that, it's the additional thing is, the risk that realized volatility increasing in one asset causes people to retrench, but also means that they need to worry about their exposure in other asset classes. Hence, we have this kind of escalating kind of snowball effect that's been magnified. So we have calmer markets again today, but it feels like, funds that will be a little bit slower to react, that don't have that very fast pace of movement that we saw for traders able to get in and out over the last 24 hours, may still have work to do. And so, when you look at the sort of typical trading patterns around a turnaround Tuesday, as people like to call it, you have the big sell-off on Monday, you have the bounce on Tuesday, then we tend to have a slower kind of reset back into the more negative mindset that you saw at the start of the week. So I think that's what people will be worried about going from Tuesday into Wednesday.
I doubt very much that risk parity, vol targeting, or trend following trades are fully unwind, not by any stretch. But that turnaround in the Japan market maybe takes the heat off the Fed in terms of how they communicate. We heard from Mary Daly, of course, still not ready to pull that trigger on rate cuts. What do you think the longer term implication or damage is here? Is it suddenly that the growth scare that we had in the United States of America on Friday is suddenly compounded? People are now really looking at China and Europe and looking at that trifecta and beginning to understand the globality of where we are at the moment.
It's so difficult to figure out, but confidence will definitely be burned in all of those popular markets after the sell-off that we've seen this week and over the past 3 weeks as well. And it takes time to rebuild that confidence once you've had a really dramatic and nasty looking sell-off. We've had a few setbacks this year, what people might term healthy corrections. This doesn't feel quite so healthy or quite so correct for that matter either. And I feel like, maybe people are going to be thinking twice about whether they want to come piling back in again. I mean, you could look at it the other way, and it seems like some people did today. If you've been wanting to buy Japanese stocks and get in on the rally, that you've missed out on it all the way through this year, then the reset right back to the start of the year in terms of pricing gave you a wonderful entry point. But on the other hand, are you going to be as fully committed, or are you going to be buying hedges? Are you going to be a little bit more cautious? Are you going to be more circumspect about what that outlook looks like and what the economic kind of impact from this market turbulence could be as well? Probably you're going to be a little bit more cautious going forwards.
Well, certainly yesterday relative to 1987, it's interesting. In 1987, Japanese banks, we just saw Japanese banks yesterday lose the most since 1987 in one day. And it certainly was a very different feeling yesterday to that of 1987. Paul, thank you very much. Paul Dobson there. But the market is contextually different to 1987, to 2000, to 2008. Heath Lerner has lived through one or two of those market experiences, the co-CIO and chief market strategist at Truist. How did it feel to you yesterday? Because it felt as if there was real cross-asset panic and deleveraging, but I just wonder to what extent was there wholesale, ripcord pulling moments by asset managers and longer-term investment people, because it's not exactly a parlous economic state that we face in the United States of America. Good morning.
Yeah, well, very good morning to you. I will say yesterday did feel panicky. I mean, obviously we had one of the biggest VIX spikes in history. It came off the highs. I could tell from just incoming calls anecdotally that there was some, certainly some nervousness. And you have to also remember, we've gone through a really serene environment, no 2% down days for one of the longest periods in history. And then all of a sudden you get a volatility shock. And, historically, we've looked at these volatility shocks. They don't tend to be over in a day because, as you have been discussing, there's a lot of people off sides. So even if you get a bounce in the market, there's this battle between fear and greed. And as you move, no one wants to take a loss. So as stocks bounce back up, you're going to see folks that look to sell into that. On the other side, people have been waiting for these pullbacks. They're going to be looking at that as well. So what tends to happen after these volatility shocks is they cluster. Volatility tends to cluster. Wide swings both ways. And I think we have some time to repair some of the damage that we've seen over the last week or so.
What's the smart thing to do here? Because you see the short end of the yield curve. I was just chatting to Sharon Bell at Goldman Sachs. Short end of the yield curve bounces by 34, 35 basis points on twos. You see the bond market act as a solid hedge. yesterday. It perhaps had question marks around that in previous sell-offs. So what is the smart thing to do here? Is it to, you know, that awful cliche, which is buy dips, or is it to pair your risk on any material bounces?
Yeah, well, I think in this case, I think time frames really matter because, again, a repair process after you have a volatility shock tends to be measured in weeks and months. Our base case for our client base, which we're looking over at least the next 12 months, we still think the bull market deserves the benefit of the doubt. But coming into July, our main focus and our discussion with our clients is that the market had kind of moved ahead of itself, that sentiment was a bit stretched, and that in that environment, a little bit of bad news can go a long way. That said, you know, corrections are not fun; they're always uncomfortable. But the emission price for being in equities, and historically, after strong first halves, the average correction you see at some points about 9%. So we're around 9%. I think this actually likely has somewhat further to go. So at this point, I would not be changing positions, you know, drastically. One thing we just did late last week is we went long duration when the 10-year was around 460. Now we're below 4%. We're taking off that duration position. And also we're sticking with the U.S. and we're sticking with large caps as well. So those are things that are just on the margin that we've been changing.
We're just showing the markets as you're talking and as I'm now in the box. You know, S&P now giving back most of its gains since I came in at 3 a.m., up 1/4%. You're looking across these equity indices at the moment, and they are just a little bit lighter on the feet. There you go. You can see the trajectory of the S&P still in the green, up 1/4%. Here's the debate, Keith. Real rates are 271 basis points. The market is probably saying that is too restrictive. Now the balancing act for the Fed is, how do you message not 25 basis points, but the reality that we're behind the curve? That seems to be the building consensus. Behind the curve, late to cut, and the necessity to do 50. How do you qualify to the market without panic that 50 basis points is a live option in September?
Well, I mean, I think it's a difficult position for the Fed, but I think if you just go by history, you are at a very restricted level when you look at the Fed funds adjusted for inflation. We're the highest since 2007, and you know, in their own dot plot, where we are with the unemployment rate is higher than where they thought we were going to end the year. Inflation, their core, you know, preferred measure on a year-over-year basis is around 2.5%. So even if we can debate what neutral rate is, but it's not 5% and it's not 4%, they're a long way away from what the Fed itself considers as neutral. So I think that in itself, along with some soft employment, suggests it's time to start moving. And why not start off with a 50 basis point move to move towards something easier, but you're still even then restrictive by historical measures.
The other, look, we're looking for canaries in coal mines. We're looking for red flags. I'm looking at credit yesterday, up over 7 basis points at 65.65, with the biggest climb since March 2023. I'd say that's a pretty natural reaction function, given the convulsions that you had in equities, given the moves that you had in FX, that credit would take a little bit of a pop. But how much attention do I need to pay to credit spreads and whether they remain relatively, and the important word here is relatively, constrained?
No, I think it's very important. First of all, our message this entire year and also still now is stay with high quality. You are not being compensated for taking credit risk in the overall market. But more specific to your question as a market indicator, I do think that's something else the Fed is going to be watching closely, because a functioning credit market is very important for the overall market. So spreads for the first time this year really started to widen the last week or so. If we start to see that move in a meaningful way, then I think the prospects of the Fed's coming in earlier could happen. But I do think that's, you know, that's extremely important for the overall markets, because you're not going to make a lot of headway in the equity market if you see credit spreads continue to blow out.
Well, as one person saying to me on the IB, there'll be no peace in markets until dollar-yen settles down and finds a level. I think they're praying rather than hopeful. Keith, thank you very much. Keith Lerner there of Truist. Context matters every day on Bloomberg. We bring it to you first.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Bloomberg Brief, I'm Manus Cranny in New York. Quick snapshot of equities. That bounce that you had on the back of Asia bouncing by 10% on the Nikkei has given somewhat of the momentum back. Still, the view from Goldman Sachs is 60-40 portfolio active pretty darn well. That's where you want to be. We've just had a conversation with Keith from Truist, and they are still Lerner over at Lerner. You want to be long, big tech, but this floor that was created earlier in the session is dissipating ever so slightly. The Russell is flat at the moment, and the Nasdaq, there you go, just dipping into the red. We'll keep an eye on those stocks as we go through the morning. And tech stocks, as we say, have been bouncing back. The sector, there you go, there's Alphabet up 0.3%, and that is despite a US judge ruling that Google illegally monopolized the search market through exclusive deals with Apple and others. Google plans to appeal the ruling. Let's get to Tom McKenzie. Tom, it was a ruling against Alphabet, but there's no breakup. Yeah. I mean, you're a huge monopoly. You've squeezed everybody. You've used your financial clout, but there's no reparation.
Yeah, and Evercore, look, analysts at Evercore say this could stretch out into 2026 until we get a definitive resolution to this. Alphabet are appealing this federal ruling, but nonetheless, Manus, this is pretty seismic. It's the most significant antitrust ruling in favor of the Department of Justice. It's their biggest case in 2 decades, the biggest one of this century. So on that level, this is significant. And what they're alleging and what they have found is that Google were using these $29 billion of payments every year, approximately, to the likes of Alphabet, to the likes of Apple, I should say, and Samsung, these exclusive deals to have their search engine become the default. That allowed them to ramp up pricing around advertising, essentially with no competitive threat. In terms of those outcomes then, and I've outlined the potential time frame that Evercore are outlining for us or describing, what you could see, ultimately, you could see the judge coming down on a breakup, maybe spinning off, maybe selling off some of these businesses, maybe splitting up Google search from the likes of Android and Chrome. Or Alphabet could be compelled to unwind some of these competitive or these exclusive deals that they have signed up and let up with the likes of Apple and Samsung. So those questions still need to be answered. Top line is, this is significant. There's also potential ramification as well for the antitrust probes that the DOJ are looking at when it comes to other big players in the tech space like Meta, like Amazon, and like Apple as well. This has set a precedent that can be used to inform some of that investigation, some of those probes into other big players within the space.
Yeah, I think the Attorney General, this is a victory against Google in a historic win for the American people. Now we just got to see whether we get a little bit more free choice. Talk to me about NVIDIA. I mean, there's two sides to this story. One, there's timing is everything. Jensen Huang selling $500 million worth of stock. I think maybe the more important one, as you and I have discussed, is the delay, potential delay in one of their AI chips. Just how much of a headwind would that AI chip delay be?
Yeah, so I was going through the analyst reactions to this. Some have said it's going to affect them de minimis. Others have described it as being a blip, maybe a wrinkle in the road for NVIDIA. So their current set of chips are called Hopper. They're moving to Blackwell, and that's where the focus of this story is. It's on that new variation of these AI accelerator GPUs called Blackwell that they were hoping to ship, and say they're still on course to ship those towards the second half of this year. But we know now through this reporting that they've faced engineering challenges to 2 of those Blackwell chips. Other analysts saying, look, it's going to come down to how quickly they fix and then ship these chips. But the demand remains for these AI accelerators, and they still don't have enough supply to meet that demand.
Okay, Tom, thank you very much. Tom McKenzie there with the very latest on the tech stories. Let's turn to Washington. The Vice President Harris has officially become the Democratic nominee for president in a virtual roll call vote. That happened on Monday. Joining me now is Zach Cohen of Bloomberg Government. So they've tidied up some of the potential challenges to the vice president running on the ticket for the Democratic Party. Now it's going to come down to, this is the fill or kill, the crunch day on her choice for vice president. It's all about somebody from the swing states, Zach. So how close is Shapiro? Is that the name that the runners and riders will come down on?
Really, the question right now is who does Kamala Harris pick as her running mate? Obviously, a job she's very familiar with after being President Joe Biden's running mate and then vice president for the last 4 years. The apparent frontrunners at this point are 2 swing state governors, Josh Shapiro of Pennsylvania and Tim Walz of Minnesota. Harris is supposed to start a barnstorming tour of the United States starting in Philadelphia tonight with her running mate, and she has interviewed not just Shapiro and Walz, but also Arizona Senator Mark Kelly in the last couple of days, as well as speaking to some other candidates, our colleagues are told. And so the vice president has a pretty marginal effect on the overall outcome of any presidential election, but can make a really critical difference, especially if Harris is hoping to balance the ticket with a perceived moderate, somebody with more appeal to maybe more rural, more independent swing voters. And so this is an important decision, if not the most important decision that Harris has had to make in the last 2 or 3 weeks as the presumptive nominee and now the nominee for president of the United States for Democrats.
And just looking at Pennsylvania, in 2020, Biden defeated Trump in Pennsylvania by 80,555 votes. That's a margin of just 1%. So that just gives you a sense of how closely balanced some of these swing states are. Do we know to what extent that they have moved with the Harris campaign?
And Pennsylvania really is the cornerstone of the entire election, not just the presidential race. Its electoral votes are certainly a sizable prize for any either Democrat or Republican that takes that state. But there's a competitive Senate race there in November, as well as a couple of really competitive House races. So Pennsylvania really is a key prize, maybe part of the reason why Shapiro remains at the top of the list, somebody who can appeal to not just base voters in places like Philadelphia and Pittsburgh, where Democrats really need to juice turnout, but also able to appeal to outlying parts of the state. Back in 2022, he was able to easily dispatch his Republican challenger, who was seen as a very Trump-friendly election denier, who had argued for overthrowing the 2020 election. So certainly somebody who could prosecute the case against Trump and put 2 former law enforcement officials. Both Harris and Shapiro were former state attorneys general, and that could be quite the contrast to Donald Trump, as he is now a convicted felon running for the presidency for the Republican side.
Zach, let's see what the name finally drops today, is what we expect. Zach Cohen there of Bloomberg Government coming up on the show, setting you up for the trading day ahead. More volatility to come. Context matters every morning, live from New York on Bloomberg Brief.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Brief. I'm Manny Scranny in New York. A look ahead today. This is what we got before the bell. Caterpillar and Uber report their earnings. So anything on the Uber and the consumer side is going to be certainly interesting by the markets. And then after the close, we'll hear from Airbnb and Rivian, plus the Democratic presidential nominee Kamala Harris kicks off a tour of 7 battleground states with her running mate in Philadelphia at 5:30 p.m. Eastern time. So we'll find out who the running mate is. Some stocks which are moving ahead of the bell this morning. This is what we got for you. Palantir up 8.3%. They boosted their profit forecast on AI demand. You got it. CrowdStrike, Piper Sandler raising his recommendation to overweight from neutral. And then Dell Technologies on Monday cut sales workers in a team shuffle and a new AI focus. I'll leave you with a snapshot of equity markets. You had Volmageddon yesterday, the biggest one-day explosion, propulsion and volatility since 1990. We are in the green, but only by a sliver. I can tell you this, JP Morgan have done the analysis. Institutional stock buying yesterday of $14 billion. Retail, guess what? We're sellers.
To succeed in Wall Street, what skills do you need? You need to be somebody who claws people in the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency. The other penny was lower G&A, blah, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
This quick turn from markets from it's all fine and we still have growth to, oh my God, the world is coming to an end, is really made all of the markets come down.
This is probably much more about market positioning as it does about how much the economic data has changed.
I think we all need to calm down a bit. This is a process, and this is very natural for markets.
All in all, I think this will turn out to be more of a technical aberration in the market.
Our number one highest conviction trade for 2024 coming into the year was volatility, and we're seeing it.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
One of the longest Mondays ever. Welcome to Tuesday. Live from New York City this morning. Good morning, good morning. Bloomberg Surveillance starts right now. Coming off the back of the biggest one-day drop on the S&P 500 since 2022. And it could have been a whole lot worse. Your scores this morning look like this. Equity futures bouncing back by 0.4% on the S&P. On the NASDAQ up by 0.4% also. It's goodbye margin call Monday and hello turnaround Tuesday. The NASDAQ 100 yesterday at the open was down 5.4% before pairing some of those losses going into the close. But the turnaround in the bond market, absolutely staggering. Sit on the 2-year, 395 right now. Yesterday morning at 8:30 Eastern time, 364.98, down 20 basis points on the session. And then we got this firmer than expected ISM, and 90 minutes later, that 2-year yield was positive, and that's where we closed. And we add to that move this morning, up 3 basis points on a 2-year at 395. So we had the data was better than expected, and we had some Fed speak. And I have to say, there was a real absence of fear in the Fed speak from Goolsby on Friday with Michael McKee, with Mary Daly yesterday afternoon. Anne-Marie, we have a reasonably solid labor market. That's the takeaway from the Federal Reserve.
And what she said is, we are slowing, but we are not falling off a cliff. Mary Daly yesterday, policy adjustments will be necessary in the coming quarters. So everyone who's saying about potentially the Fed will go before September, not going to happen. We have now confirmed that the labor market is slowing. They've confirmed it. They've seen the data. And it's extremely important that we not let it slow so much that it tips itself into a downturn. So once again, she's setting the market up for September, but she's not saying that the labor market has massive cracks in it and we should see this sort of exuberance we saw in the market. It's slowing, but not falling off a cliff.
Started the program yesterday by saying, let's take a giant step back. Let's do that again. Let's take a giant step back and think about, just historically, just frame some of the moves we've seen in the past 24 hours. Jim Reed of Deutsche Bank, let's take this quote. What a once-in-a-lifetime GFC period could not do, and a liquid August day in 2024, with one bad weather-related payrolls print for fuel, did with some ease for a period of time yesterday. What would have happened if we'd have had a negative payroll print? Jim Reed at Deutsche Bank. Danny, we talked about it in Japanese equities. Everything that's happened since 1987, everything, GFC, long-term capital management, the bust of the dot-com boom, all of that, the pandemic that lasted about 2 years. What happened yesterday was absolutely phenomenal worldwide.
It is, and it's interesting to hear the language about it today, because I've heard so many criticisms about the BOJ, saying the only thing that happened was the BOJ made a huge mistake in hiking, and that's what set off this cascading effect. I find that a bit disingenuous, because it was like this perfect storm. Sure, the BOJ hikes. You also had recession fears. You also had the AI hype. Is that too much? Everything came together, and if anything, it just showed us when the economy is slowing, it does not take that much for a rally to unwind itself.
We'll spend some time on Japan. Let's check out dollar yen just briefly. We are a little bit more positive here compared to yesterday by 0.5%, approaching 145 at 144.85. A big rally in the Nikkei 225, a move of more than 10%. And we'll get to the size and scope of that move a little bit later in the program. But let's talk about this carry trade. I've heard so many people talk about the carry trade. Danny, I got several messages on the Bloomberg terminal yesterday from people on the actual buy side, not strategists trying to come up with a reason as to why the market was doing what it was doing. People on the buy side who were saying, exactly who is in this carry trade? What is going on here? How many people are in this? How much of it has unwound? We heard this from JP Morgan overnight with our team here at Bloomberg. The carry trade unwind, at least within the speculative investing community, is somewhere between 50 to 60% complete. Do you think this is becoming sort of like an excuse, a good excuse, a reason? What is this?
I think it's people just grasping at straws, because who actually knows the size of this thing? I haven't really heard any good calculations as to how people are coming up with these numbers, because sure, you can just talk about the speculative end of the trade. You can look at CTFC futures and try to get an idea, but this thing is potentially bigger. It could potentially be, I don't know, people who are holding longer term contracts, but this all just underlines the point. We don't know, and a lot of people are unsure. There are people on Friday who said that move meant that all the shorts were washed out, and then you get yesterday. So I don't know. I just find everybody is saying something different, and there's no clear answer out of any of them.
Weaker Japanese yen on the board this morning. Let's see if that move sticks. Futures fade just a little bit. The S&P's positive by about 0.4%. Coming up this hour, we've got plenty of questions. We'll try and get some answers with Peter Chi of Academy, following the worst down the S&P since 2022. Eric Nelson of Wells Fargo on why the moves in dollar yen are probably done for now. And Terry Haynes of Pangea Policy as the world awaits Harris's VP pick. We begin with our top story. Global equities bouncing back. Stocks rising following the worst down the S&P 500 in almost 2 years. Peter Chi of Academy writing the following: I don't see signs of a bottom yet. While we are likely to get some tradable bounces, don't get too cute trying to buy this dip. Pete joins us now for more. Pete, good morning to you.
Morning.
Let's take that giant step back. Let's talk about this carry trade. What do you make of that, just as an excuse? Is that a reason or a convenient excuse as to what's been developing in the last 24 hours?
So I think there are a lot of people who are very levered into this market. I don't know whether they borrowed in yen or what currency they borrowed in or where they borrowed, but I do sense that there was a lot of leverage positions. People were fairly aggressive in their risk positioning. That's part of the unwind. You look at all the vol selling strategies. They've all done phenomenally well. People have been piling into that, zero data expiration options. All those things are all signs of, froth, leverage. And what I think people are forgetting, to me, and I had a lot of conversations about this yesterday, is when things go up, it's fundamental, and it's my view that caused this. It wasn't anything to do technicals. On the way down, it's all technicals, these will end.
Of course.
So a lot of the reason why we got to where we were technicals, and those are unwinding, and it's a multitude of factors, and I think the carry trade's part of that, but I think it's much more just leverage and option selling, vol strategies, and people overestimating where we are in AI.
We've had a lot of shocks and a lot of scares over the last decade. So let's go through them. 2015, August, I think it was the Chinese devaluation. 2018, we all remember that December when the high yield market completely froze up here in the United States. We can go back as recently as last year when we had the banking shock, and we move on with life. You get over it and you move on. You move on quite quickly. What's the good parallel for this moment we've been in over the last week or so?
Since you mentioned, I think 2015, there was a time there was high yield, and it was getting destroyed every day. Energy was a big problem. They launched a high yield ETF without energy. That was pretty much the bottom. So I think we need something that takes away the froth here. And that's why I keep looking. It's, when we looked at ARK was really doing really well, and then it started turning over. You kept having inflows until it really got hammered. So I've been watching this NVIDIA leveraged ETF. I have no idea why it continues to get inflows, but it is. And that, to me, I look at that. I look at triple level QQQ, so TQQ. These aren't the biggest ETFs, but to me, that's kind of, you're trying to figure out where there's froth, what's the real sentiment. I have not seen de-risking. I've seen degrossing. I think some people have had to take some leverage off, but I haven't seen anything that panic. And yesterday, all anyone talked about is don't panic, don't sell. But maybe you should be selling, because I think we're going to break through the 200-day moving averages, and that could create a vacuum with this sort of liquidity.
You're talking about when the knife hits the floor. I want to talk about what happens after it. If momentum turns, and maybe that sentiment that, oh yeah, that rally was because of my fundamentals, not necessarily because of mechanics, does that disappear and we don't get the same type of rally that we've been used to?
Yeah, I think it sells off a fair bit. And you mentioned momentum, right? And so momentum had been probably the best factor all year. So momentum stocks have worked very well. And what I think we're going to really get exposed is that passive has now become somewhat of a momentum strategy, right? Every dollar that went into a QQQ or every dollar that went into an S&P fund, 50 cents of that was going to just a handful of stocks. So as those starts rolling over and people say, well, I want to take some money out of the market, they're actually going to be taking out of those same 50 stocks. So I think that, or sorry, those same few stocks, I think that's going to propel this much lower. It's going to be scary. And we always have to laugh, but everyone always says, if a stock just gets down 10%, I'd buy it here. And what people really mean is, if the stock goes down 10% for no good reason, and I still have plenty of cash, I would buy it there. That's never what happens, and that's why I think there's more downside.
Okay, if there is more downside, you saw in yesterday's trade of what happens when correlation goes to 1. Basically, everything fell. There was a flavor of the bond proxies doing okay. Should we use this as a playbook for what happens in moments of volatility?
What I liked yesterday, and I've actually had sold a bunch, I liked China at the start of the year, I'd been selling some. Chinese stocks actually didn't do that badly yesterday. They did reasonably well. You start looking at the Bloomberg terminal today, you've got a really good story about these Chinese brands that are making big inroads into the US and elsewhere. So I think made by China is interesting. Their economy's starting to turn. So, and they were the one thing that did seem to decouple yesterday. I think it was down like 0.5% or 1% when the S&P was down 4 or 5%. So FXI is kind of one of the things I'm starting to look to. And I do continue to like energy. I was down, so we're going to start adding to that because I do think that there's real risk of geopolitical events going across the globe. And every way we look at it when we analyze it at Academy Securities, we've got a team of generals and admirals retired. It really points to oil supply shocks.
When you look at, though, buying into China, because this whole made in China nationalism with some of these brands, does that mean you think we're at the end of U.S. exceptionalism?
Yes, I think it's already becoming that. You look at some of these brands, BYD automobiles, creeping up. And so what we've looked at, we've been calling it this, I think we've talked about it before, but this transition from made in China, where they made our brands, to made by China, where they've got their brands. Their big target audience is going to be a lot of the emerging markets. They have these trade deficits to a lot of those countries because they've been importing the raw materials. So China Inc. is going to be very aggressive in that. And look to Europe. That's going to be the weak link kind of in the West, and it's going to be Italy or Spain because their economies are slightly more dependent on China. Their economies are slightly more weaker. I think you had a great interview yesterday with 2 days ago with the Stellantis CEO, and they were talking about pressure that Italy's putting on them. So China's going to start using that. You look at who's selling phones within China. It's the Chinese brands are doing better and better. They're going to start exporting that, and I think it's going to be this value proposition that maybe the quality's not quite to our brands, but the price is going to be a fraction of that. And for a lot of people across this world, that's going to be a determining factor.
Can you develop an FX trade based on that?
Not really, because I think I really wouldn't trade the yuan. So I would stick more to the FXI and just keep it on the equity side of things right now.
Okay, because we've seen some real dollar weakness, particularly in the last 24 hours. I got this note just months ago. I want to share it with you. What if the Fed delivers on the rate cuts that the market is asking for? Now, that's going to have big consequences, obviously, for the FX market, but potentially for the broader economy and equities as well. This is what SocGen's got to say in response to that question. If the Fed were to deliver on what the rates market is asking for, we believe that cyclical data, such as the ISM, would rise into boom territory. What do you make of that? If this market got what it actually wanted, where would this economy be?
Ooh, I think we'd see inflation right away because people would see, okay, well, the Fed's got the Fed put, we're all there. So I think you'd start seeing inflationary pressures. I think you'd see a bit of a boom. I think we'd roll over again, though. People would be like, this is, and maybe stocks have to do well, but it would be complete capitulation, I think, by the Fed. There is no reason, given how they've analyzed the data, for them to give the market what it wants. We've got to see more data, and by the time I think it would have to be such bad data, and I do think we're going to get weaker and weaker data. I think the jaw's been overstated for a lot of reasons. I think they're doing a lot of miscalculations in some of these. But then you get the data, you get the cuts, but we're going to need it because the economy's rolled over. So I don't think there's an emergency cut or 50 or 70.
I've got to ask the question, though, because everyone's stampeded to the other side of the boat. They're looking over the edge and they see this horrible shark and it's got written on it, bad labour market. And on the other side, no one's talking about inflation anymore. Do you think we're underpricing the risk of inflation picking up in this country?
If the Fed reacts, I think we would get inflation again. I think if not, it's actually become quite deflationary right now. You're seeing things roll over. You look at, I have no idea why in this day and age we use OER, right? Can't we find a better calculation for shelter? You look at anything that's kind of contemporaneous about rent, It is coming down. It's been lower, and we're still kind of basing policy off of that. Auto insurance had some really good discussions with people, right? There are no price increases coming through, and that's been one of the big drivers of CPI was auto insurance. You start looking at everything else that's coming down. Manheim Used Auto Index is one of my favorite. It's well off its highs. So I think we have this kind of chance to actually get deflationary. And my whole theory, it's been very simple, is we had two bumps. We had a COVID goods bump, where goods became very expensive very quickly when people could get their hands on it. They had all this money, it came off. Services took longer to play out because each state had different rules, each country had rules, and individuals had different preferences when you were willing to do that. So that bump played out, and now that's starting to roll over, right? Look what we're hearing from the airlines, the hotels, right? So that trade's over. I think we're on a deflationary period. People are spent out, they're tapped out of their money, and jobs are starting to become hard. No one's quitting anymore, right? I think we are really at the cusp of real economic weakness.
Signs of the labour market just freezing up just a little bit. Pete, it's good to see you. Peter Chair of Academy. If you are just tuning in, I imagine you want the price of one thing, and that's one currency pair. It's dollar-yen, 144.63. We're just about positive on the session by a third of 1%, but that move is fading. Likewise in the equity market, so we'll keep an eye on that throughout this morning for you. Let's get you an update on stories elsewhere. We can do that with your Bloomberg Brief and Yahara Hackers. Hey, Yahara.
Hi, John. A U.S. federal judge has ruled that Google illegally monopolized the search market through exclusive deals with Apple and others to make its search engine the default browser on devices. The ruling hands the government a victory in its first major antitrust case against the tech giant in more than 2 decades. Attorney General Merrick Garland calls it a historic win for the American people, while Google says it plans to appeal. Vice President Kamala Harris has clinched the Democratic nomination for president. The virtual roll call vote wrapped up last night, and the Democratic National Committee says the vice president won 99% of the delegates' votes. Now the question is, who will join Harris on the ticket? She's expected to announce her running mate today before kicking off a campaigning tour of 7 battleground states starting in Philadelphia this afternoon. She'll formally accept the nomination later this month at the Democratic National Convention. And at least one person is hoping for a Vice President Tim Walz. Jeremy Green Eek bought HarrisWalz.com for $8.99 in 2020 when Harris sought the Democratic nomination. He told the Associated Press he's willing to sell it and a dozen other Harris websites for $15,000. This is not a new scenario for the New York trademark lawyer. Back in 2011, 5 years before Hillary Clinton selected Virginia Senator Tim Kaine to be her running mate in the presidential race, he purchased ClintonKaine.com. That's your Bloomberg Brief. John?
Yahara, thank you. We'll see Yahara again in about 30 minutes' time. He must buy so many websites and just sit on them.
But also, if it is Governor Walz, why is it only going for $15,000? You have to imagine you can get a lot more for that.
Oh, you think he should be selling for more?
Yeah, I think so.
Okay, you heard it here. All right. Up next on this program, unwinding the yen carry trade.
Looking at the various suite of positioning metrics we have, we think that the carry trade unwind, at least within the speculative investing community, is maybe somewhere between 50 to 60% complete. So we are not done by any stretch.
More on the latest from Japan, up next on the program, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Bloomberg has enhanced search on the terminal. to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep reading World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond. Live from New York City this morning. Good morning. Let's do this all over again. Welcome to the program. Let's get to equity futures first. Just a little bit of a bounce here. With the emphasis on a little, it's not a big one. We're up about 0.5% on the S&P. Bond yields pushing higher on a 10-year, up by 5 basis points, 383.71, much, much higher than where we were this time yesterday morning at the front end of the yield curve. The 2 years up by another 3 to about 395. Big focus on dollar yen. Just a slightly weaker Japanese yen in the mix, 144.68 on that currency pair. Under surveillance this morning, unwinding the yen carry trade.
We think that the carry trade unwind, at least within the speculative investing community, is maybe somewhere between 50 to 60% complete. So we are not done by any stretch. Some of the technical studies we've done suggest that once you get very large, sharp moves in short periods of time, like we've had with the yen, the technical damage that it inflicts on portfolios is not easily undone.
So here's the latest on this front. The yen has taken a breather following the biggest 5-day rally since 2008. Eric Nelson of Wells Fargo writing the following: the dollar-yen move has been quite extreme and probably done for now. Looking ahead, we see reasons why dollar-yen should continue to fall on trend after a short-term retracement. Eric joins us now for more. Eric, looking forward to spending a little bit of time on this with you this morning. I want to go to those comments from JP Morgan that we think the carry trade unwind, at least within the speculative investing community, is maybe somewhere between 50 to 60% complete. Eric, where are these numbers coming from? I think there's a lot of interest in this from people outside of this world. How big is this trade? How do we know how much of it has unwound?
Yeah, there's lots of different metrics you can look at. The number we like to look at is just in the CFTC, the futures data. It's probably the most widely available number. If you look at total short positions from hedge funds and asset managers in aggregate, those total positions have fallen about 50%. So sort of consistent with what we've heard. Now, I think there's two ways to look at this. There's looking at it in a vacuum and just saying, well, if this goes to 0, then you have another 50%, right? Maybe a better way of looking at it is, are we actually going to see a real level change here in recession concerns? Because for all the talk about growth concerns, I've talked to very few investors who really have genuine recession fears. Growth forecasts have been marked up for the global economy, looking at consensus forecasts for the last 3 to 4 months straight. If you have a genuine recession fear come through, if you start to see that in growth forecasts, that's when you can unlock the next leg of dollar-yen downside. I don't think we're there yet, though, and tactically, probably we bounce a little bit.
So, Eric, we spent a lot of time talking about the Federal Reserve's role in a lot of this, how they might step in. Let's park that craziness, that silliness just for a moment. I want to talk about the BOJ. The BOJ was uncomfortable with dollar-yen on the way up. How comfortable is it with the way it's moving down?
I suspect it's probably moved a little bit too fast for them. They have to probably expect this sort of move would happen, though. We know that with these carry trades, it's up the stairs and down the elevator. So it's a little bit, obviously disruptive for them. They want to see stability. Obviously, the BOJ hike a couple of days ago has probably exacerbated the extent of the move, but I certainly don't think they're at the point where they're worried about or sort of feeling the need to step in here and react to this move with actual policy action. And I'm not sure it's not necessarily going to change the way they think about policy normalization going forward. I think they probably think it's stabilized. They'll watch the market and see how things go.
Eric, you said it exacerbated the move, the BOJ hike. There's been a lot of commentary this morning that it is the root cause of the rapid appreciation of the yen, that they made a policy error in hiking when the economy couldn't handle it. What do you make of that conversation?
I think it's hard to say it's the root cause. I mean, we'd already moved basically 7-8% before the BOJ hike came through. So a lot of the move happened prior to the BOJ hike. I think that it did exacerbate it in the sense that we had this kind of sort of cross-market correlation, Varsha, call it whatever you want. Everyone was in the same trades, right? That's really what I think characterizes this market as best I think as it can be. So I think the extent we've seen, the unwind in long Japanese equity positions, the unwind in dollar yen, maybe the BOJ hike has exacerbated that risk-off move. But the root cause, I think, is maybe not. I wouldn't agree with that characterization.
So the unwind happens, Eric. What, if anything, could even take the place of the yen as a carried trade? Who's to say that people don't just pile back into this thing, given that yield differentials are still pretty large, even with the move?
Yeah, and this is the thing. I mean, part of the question or concern here is this still an environment you want to be putting on carry trades over the next few months, right? We've obviously had a level shift in the volatility environment across markets. Growth, like I mentioned, there was a lot of complacency around growth. That may start to change the next few months. I don't know that this is the environment where you're going to see people rush back in to put on carry. If anything, I think you're sort of in the opposite environment where people are looking to take off carry and looking for opportunities to do that. And that probably limits the upside in dollar yen here, unless we have a consistent several months in a row of very strong U.S. and global data where it's very evident that recession fears are unfounded, and that may be a little bit tricky to see.
Got about 60 seconds left. I've got to ask you, have you got a favorite trade right now, Eric, given how much it's blown up over the last few days?
Well, I'm a little bit skeptical that we're going to continue to see this dollar weakness. You're looking at euro dollar at 110. I understand the rate differentials have moved in euro's favor and out of favor of the dollar, but I think some of the dollar weakness has been a function of just dollar yen kind of unwinds. So particularly looking at sort of buying the dollar versus some of these more growth sensitive currencies, Swedish krona, certainly one of them, even the euro itself. If we start to see that repricing and growth, that should start to weigh on some of these other non-dollar currencies.
The euro pulling back this morning. Eric, thank you, sir. Eric Nelson of Wells Fargo, the euro there against the dollar at 109.09. For all this talk about a weak dollar and an aggressive Federal Reserve, Morgan Stanley, Ellen Zentner, had this to say: "We don't think payroll spells real weakening. Could be weather, could just be noise. The Fed would need," this is the interesting point, "the Fed would need less than 100K in August payrolls to consider a 50 basis point cut." Mike Froley's already there. He's going to join us on a program a little bit later. Hollenhorst is already there. Zentner's basically saying you need a sub 100K payrolls print for the Fed to consider 50.
And I think given history, it's probably fair given the revised print in April was 108,000. I mean, we didn't freak out then and said that the Fed was going to do an emergency cut, but this time we are.
September 6th for the next payrolls report. The Federal Reserve decision September 18th, and we said on this program yesterday repeatedly, I know that's just around the corner, but that feels like a lifetime away. Coming up on this program, waiting on Kamala Harris's VP pick. We'll catch up with Terry Haynes of Pangea Policy in just a moment. From New York, this is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Live from New York City. Welcome back. Let's get to the futures. Equity futures on the S&P 500 positive by 0.6%. On the Nasdaq 100 up by 0.7%. Just a little bit of a bounce. Remember on Friday, the Nasdaq entering correction territory. The S&P 500 almost joined it, just fell short in yesterday's session, but still posting the biggest one-day drop in almost 2 years. The turnaround in the equity market is small. In the bond market in the last 24 hours, it's been anything but small. It's been large. The two-year yield at 8:30 Eastern yesterday, Danny and me were going through it together, 364.98. We were down almost 23 basis points. And then we turn around 90 minutes later on the data. ISM services coming in better than expected. Business activity, new orders, regaining expansion, the employment component, Danny, all good, 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 tick, 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 and certainly in sharp contrast to what we heard last week.
By the way, we also got SLOOS data, which was also strong. Weakening in credit conditions, we haven't seen that. Less lenders were tightening standards. So when you ask about what demons were exercised in yesterday's trade, the recessionary one, that certainly was helped by the data. The AI one, maybe not as bad as we thought. Maybe the carry one still has room to go. And that's why everyone kind of says, is the worst over? I don't know. That seems to be the answer.
Let's talk about the carry piece of this. I think the first thing a lot of people are looking for, you sort of wake up, get out the Bloomberg terminal, Bloomberg anywhere. Is this just me? I think this is basically everyone. Check out dollar yen, see where, just me. Dollar yen looks like this right now, 144.97. I think a lot of people are waking up this morning, Danny, and are turning to this one just to gauge where things are at over in Japan.
Yeah, when does a 10% equity rally and a 0.5% rally in the dollar versus the yen disappoint? It disappoints when the action was so big yesterday. So sure, we are turning around, but I think so many people were struck by the speed at which the collapse happened, which has people kind of rubbing their eyes saying, should I actually believe the turnaround that we're seeing? Should I actually believe this? When potentially the fundamentals could just re-up this trade if you get any more whiffs of recessionary fears and any more whiffs that Japan is still willing to hike more.
The move on the Nikkei, never mind the yen. The Nikkei 225 had its worst day since 1987, Monday. Tuesday has its best day since 2008. That is wild, wild volatility.
It is a whipsaw of a trade, and I know it wasn't as bad in the U.S., but you still got that whipsaw. You still have seen the big AI names whip around like that with so many people who love Japanese stocks, with so many people who love U.S. AI stocks. Can you really have as high conviction when you can just get bullied around so easily like that?
Well, they should love it even more after the movie yesterday, shouldn't they? That's the price action under surveillance this morning. Global equities bouncing back in Japan. The worst day in the Nikkei since 87, replaced and followed up with the best day since 2008. In the United States, futures rising just a little bit following the biggest one-day decline on the S&P since 2022. If you're looking for data, I've got bad news for you. You're going to have to wait. We've got a trade balance. I'm not sure what that's worth a little bit later. You've got to wait for jobless claims on Thursday, 8:30 Eastern. That's the next stop for this labor market.
And it's a scary one given what this market has done. Like, I can't imagine anyone will be going into Thursday saying, I'm going to just go full on risk and I'm going to buy everything. So I'm curious to know what the price action looks like into it. But again, I think Monday really showed us when the economy is slowing, it does not take a lot for a rally to unwind itself. And kind of the flip side of that is when the economy is strong, it doesn't take a lot for a rally to get going. We're just on the other side of that coin right now.
This was a growth scare ignited by the data, amplified by the unwind of the carry trade. As for the data, are we going to embrace good data as much as we seem to run away from bad data? I guess to Danny's point, we'll find out on Thursday. Claims in and around 250. Let's hope they come back in. If they don't, they gap higher. Do we get back into that recession mode like we saw on Friday's session?
Well, I was going to say, kind of in the morning of yesterday, I would say, okay, this market is so offsides. We've rallied so much in this bond market. Surely the bar is really high for a disappointing jobs number for that rally to continue. But we gave that up yesterday in a stunning reversal. So maybe the buying of bonds, a much lower front yield, it could still have more juice just by the very fact that it undid itself yesterday.
Light on data and light on Fed speak as well. I'll say that too. We have heard from the San Francisco Fed President, Mary Daly. This is what she had to say. The labor market is showing some signs of softening and the central bank could begin cutting rates. How much the Fed will have to cut and when, she said, will, quote, depend a lot on the incoming information. And I have to say, my big takeaway was her assessment of the labor market. She used this word softening, sure, but we have a reasonably solid labor market